So hello all my dearest students of South India. I hope you all are doing good and your preparation of your CA final direct tax is going on great for your upcoming exams of May 24 and November 2024. Now, as I promised you all that I will be making a video on all the ICAI's MCQs which are there on their portal. The first promise which I have made you all, that is I will compile all the ICAI MCQs which are there on the ICAI portal, and I'll make one PDF and give it to you all. That I have done it already. You can check the PDF in my Telegram channel. The second promise which I have made you all is that I'll make a video explaining the reason of each and every MCQs so that you don't waste much time on understanding each and every MCQs. And the third thing is I will be also putting the timestamp below the video so that you can search the respective MCQ, whichever you are not comfortable with. You can go and directly search that MCQ so that you don't waste time in searching the entire video. Okay. So today our objective is to do the MCQs that is there on the ICAI portal, and ICAI has divided all the MCQs into chapter wise and further into three categories: simple category, medium category and difficult category. So I have also divided all the MCQs chapter wise first of all, and then into three categories: simple category, medium category and difficult category. Okay. So let us start with the first chapter, that is the basic concepts of income tax, and in that a simple version, MCQ number 1. Okay. Let me read the MCQ first of all and then I'll tell you the correct answer and what is the reason for this answer. A music academy as per its rules pays fixed honorarium per concert to each musician performing in the concert organized by it. So a music academy is paying some honorarium to the performance. Okay. Now Mr. Hari is a violinist. Okay. However, refuses to accept this sum. Mr. Hari is saying that don't pay me the money. In fact, Mr. Hari is saying to the music academy that whatever money is due to me, pay directly to one institution, that is to a trust. Okay. Directly pay to the trust. And then Mr. Hari is making an argument that this is not my income, because I told the music academy to pay directly to the trust. Now, can I say that this is a diversion of income by overriding title? The answer is no. This is an income of Mr. Hari first, and then Mr. Hari has applied this income. Therefore, this is first earned by Mr. Hari and then it is given to the trust. Then it is trust income. Therefore, it will be chargeable. It would be chargeable in the hands of both Mr. Hari as well as the institution. Are you clear? I hope it is clear to all of you. And rest of the three answers are incorrect. The fourth one is the correct answer. Okay. The concept of application and diversion of income is applicable in this question. I hope it is clear to all of you. Now let us move on to the second one. The second one is MCQ number 1, chapter 1, medium. During the previous year 23-24, Mr. Akash has 80 lakhs of long-term, short-term capital gains under 111A. So STCG under 111A 80 lakhs and 70 lakhs of long-term capital gains under 112A. So 70 lakhs of long-term capital gains under 112A and 90 lakhs of business income. Which of the following statement is correct, assuming that Mr. Akash pays tax under the default tax regime under 115 BAC? Now, what will happen in this case? So, if you remember, there is a table of surcharge. Do you remember that? There is a table of surcharge. The question is asking which of the following statement is correct, assuming Mr. Akash pays tax under the default tax regime. So, here the question is how much surcharge will be imposed on Mr. Akash. So this case comes in the last category of surcharge. Okay. Where other income does not exceed 2 crore rupees. It comes in the last case of surcharge. Okay. Where your total income including the special income, listen carefully, where your total income including the special income is greater than 2 crore rupees, but it does not fall under the above categories. It does not fall under the previous categories. Listen carefully. Where your total income is greater than 2 crore, but it does not fall in the previous category. So in that case, the surcharge will be imposed at the rate of 15% on the entire tax. On this also 15%, on this also 15%, and on this also 15%. So it is 15% in all the three cases. Okay. I hope it is clear to all of you. Okay. Now, coming to the next one. X Limited is a domestic company not opting for 115BAA. If it is not opting for 115BAA, it means it is opting for the normal provision. Has a total income of 10 crore and 1 lakh rupees. The gross receipt of the X Limited for last to last year is 260 crore. Now, if the gross receipt, if the turnover of a company, of a domestic company for last to last year is up to 400 crore, then the tax rate will be only how much? 25%. Now, this is the concept of marginal relief. What you will do? Your income is just about 10 crore. So, up to 10 crore, how much surcharge is imposed? 7% to domestic company, and above 10 crore, it is 12% to domestic company. So, what you will do? You will compute tax on 10 crore and surcharge on 10 crore. Okay. First compute tax on 10 crore and surcharge on 10 crore, and then add 1 lakh rupees. That is the extra income about 10 crore. What is the extra income about 10 crore? It is just 1 crore. So first you will compute tax on, this is how you compute marginal relief questions. Okay. You need to go and study the concept of marginal relief first. So compute tax on, if you compute 10 crore, if you earn 10 crore and 1 lakh rupees, first you have to compute tax and surcharge on 10 crore, and then you have to add the extra income about 10 crore. So that comes to 2 crore 68 lakh 50,000 rupees. Okay. And then you also have to apply cess of 4%, which ICAI has not done over here. So their answer is wrong. ICAI should apply cess over here, yaar. They forgot to apply the cess over here. The ICAI has just put what? The ICAI has just computed the tax and surcharge and then added 1 lakh rupees. They have not computed the cess. In fact, their answer is itself is wrong. They have given two answers as same only. See, 2 crore 68 lakh 50,000, 2 crore 68 lakh 50,000. Two times they have given the same answer. But unfortunately, I need to check the most appropriate one. Therefore, the most appropriate one is this one. It is not 291 and 334. Definitely not. But the correct, absolutely correct answer is 279 24,000. This is absolutely correct answer. In exam, this will be correct answer. Okay. So be very careful about it. Okay. In exam, they cannot make such kind of mistakes. Now, let's move on to the second topic, that is PGBP. And what is the first question in PGBP? The first question in PGBP is about Mr. Y Limited purchased computer of 10 lakh rupees on 5th October and it was put to use on the same date. Now, if you purchase computer on 5th October, then you compute from 5th October to 31st March, it is less than 180 days. And if it is less than 180 days, you will get depreciation at the rate of only 50% of your normal rate. What is the normal rate on computer? Normal rate on computer is 40%. So what is 50% of that? Only 20%. And therefore you will get only 2 lakh rupees deduction on this because the computer is used for less than 180 days. I hope it is clear to all of you. Is it clear? I hope it is clear. Next one, Mr. Arvind engaged in the business of wholesale trade, has a turnover of 90 lakhs. How much turnover? 90 lakhs for the last year. For 20 to 23, the turnover is 90 lakhs. And 210 lakhs for previous year 23-24. For current year, it is 23-24. Okay. Now, in the previous year, he has paid a salary of 3 lakh rupees to Mr. Hari, a resident, without deduction of tax. So, on salary of 3 lakh rupees, is it liable to deduct TDS? The answer is no. Why? Because the income is not chargeable to tax. If the assessee, if the other person follows, if the employee follows new regime, then up to 3 lakh there is no tax. If the employee follows old regime also, then also up to 3 lakh there will be full rebate. Okay. So there is no question of what? Tax on salary. So therefore there is no need to deduct TDS on salary. But he has also paid commission of 51 lakh rupees to Mr. Rajesh, a resident, without deduction of TDS. Now, for commission, which section is applicable? First, 194H. But 194H is not applicable to this person. The reason is because he is an individual and his last year turnover does not exceed 1 crore rupees. So in case of individual HUF, 194H is applicable if the last year turnover is greater than 1 crore rupees in case of business and greater than 50 lakh rupees in case of profession. So 194H is not applicable. But is 194M applicable? The answer is yes. He is liable to deduct TDS under 194M because the payment exceeds 50 lakh rupees. Therefore, he has not deducted TDS on 51 lakh. Therefore, 30% of 51 lakh, which comes to 15 lakh 30,000, will be disallowed under the income tax law. I hope it is clear to all of you. 194H is not applicable, but yes, 194M is applicable for those people for whom H is not applicable. Is it clear? I hope it is clear to all of you. Now let's move on to the medium MCQs of PGBP. It's a big one now. Let's read the question first of all and then we will see the possible answers. Okay. The turnover of Mr. Arav engaged in wholesale trading business for previous year 23-24 is 2 crore and the gross receipt of Mr. Vishal engaged in legal profession is 50 lakhs. So Arav is engaged in business and Vishal is engaged in profession. Now Mr. Arav has been regularly following mercantile system and Mr. Vishal follows cash system. So Arav is following mercantile accrual and Vishal is following cash system. Okay. Now out of the turnover of Mr. Arav, he receives 1.2 crore through what? Through ECS during previous year 23-24. He receives another 60 lakhs through ECS on or before the July, that is on or before the due date of filing of return. Okay. And Mr. Vishal receives 30 lakhs by account pay check and 20 lakhs by cross check during the previous year 23-24. What would be the income chargeable under the head PGBP? If they want to minimize their tax liability, both of them maintain books of accounts as per 44AA. Income computed as per the regular provision is 11 lakh 50 and 24 lakh 75,000 in the hands of Arav and in the hands of Vishal respectively. However, they have not got the books of accounts audited and do not intend to do so in the future. Okay. Now, let's talk about both of them one by one. Let's talk about Arav first. What is Arav doing? Arav is doing business. And what is the turnover of Arav? Arav turnover is 2 crore rupees. So, if Arav follows 4480, he is not getting the accounts audited. So, he obviously has to follow what? 4480 only because he doesn't want to get the account audited. Okay. Now, 4480, how much money is received by 4 modes, that is account pay check, account pay draft, ECS and such as electronic mode till the due date. First 1.2 crore is received by ECS during the year and then 60 lakh is received on or before the due date through ECS. Okay. So 180 lakh is received by 4 modes till the due date. So on 180 lakhs, the deemed income will be 6%. So that will be 10.8 lakhs. And on remaining 20 lakhs, the deemed income will be 8%. So that will be 1.6 lakhs. So Arav's income will be 10.8 plus 1.6, that is 12 lakh 40. For Vishal, it is very straightforward. In case of a profession, there is nothing like, first of all, legal profession is covered in 44 ADA. Yes, he is covered. He is doing legal profession, Mr. Vishal, and legal profession is covered under 44 ADA definitely. Okay. Now, he is receiving 50 lakhs, 30 lakhs by account pay draft and 20 lakhs by cross check. Now, in case of profession 44 ADA, there is nothing like you should receive by 4 modes, etc. For everybody, it is 50% only. For him, it is 50% as per 25 lakhs. Okay. So, for him, it will be 25 lakhs rupees directly. So, in case of 44 ADA, there is no two different deemed income rates. In 44 AD, there are two rates. For online modes, it is 6%. For others, it is 8%. But in ADA, it is 50% for everybody. Okay. I hope it is clear to all of you. Now, let's move on to the next question. X Limited is engaged in the business of letting out of property. So, what is the business of X Limited? Letting out of property. And as per the memorandum also, it is written that letting out is the main objective. Okay. Letting out is main objective. The total income of X is only rental income. Okay. Therefore, what does here common sense says? If X Limited's main income is let out and their memorandum also say it is let out and their only income is rental income. Okay. Their objective is also rental income. Therefore, whatever rental income they will earn as per the Supreme Court judgment of Chennai Properties and Investment Limited will be PGBP income. Yes, I hope it is clear to all of you. Second one, Y Limited is engaged in construction and sale of properties. Okay. Whose main objective as per the memorandum of objective is construction and sale. So, what is the main objective of Y Limited? Construction and sale. Incidentally, it let out some of the property as and earns rental income. Now, for Y Limited, rental is not the main income. Therefore, for Y Limited, the rental will be considered to be what? As an income from house property. Therefore, for Y Limited, rental income is income from house property, and for X Limited, the rental income is what? It is a PGBP income. I hope it is clear to all of you. Is it clear? I hope it is clear. Let's move on to the next chapter now. The simple MCQ of capital gains, MCQ number 1. A Limited, an Indian company, is buying back some shares. Okay. So, what is the tax consequence in case of buyback of shares? In case of buyback of shares, it is very simple. The company who is buying back will have to pay tax at the rate of 23.294%. How does it 296%? How does it come? 20% tax the company has to pay plus 12% surcharge and 4% cess as per 115 QA, and then that income is exempt in the hands of shareholder under section 1034A. So, this is the treatment of buyback under the income tax law. So, if I am buying back something, I am liable to pay tax. Company is liable to pay tax on the distributed income. How to compute distributed income? The distributed income should be computed as per Rule 40BB. Rule 40BB tells you the way of computing distributed income. On that, the company has to pay 23.296% and the shareholder is not liable to pay any tax under the income tax law. Okay. Now let's move on to the next medium MCQ of capital gains. There are two people over here, Miss Aparna and Miss Dimple. Both are Indian citizens residing in California since the year 2010 and they visit India for 60 days every year. On 1st of March 2024, Mrs. Aparna transferred to Mrs. Dimple in California for consideration of a dollar equivalent to 50 lakhs rupee denominated bond issued outside India of X Limited, a company incorporated in India, which were acquired by her on 1/3/2022 for price dollar of 10 lakh rupees. What will be the tax implication? First of all, let me tell you the residential status of both Aparna and Dimple. Both Aparna and Dimple, they are Indian citizen and they are visiting India every day for only 60 years. Every year for only 60 days. Oh, sorry. Every year for only 60 days. So remember, if an Indian citizen or a person of Indian origin comes to India for less than 120 days, visits India for less than 120 days in a year, then that person is always non-resident. This is the last category of residential status. I am again saying, if an Indian citizen or a person of Indian origin visits India in a financial year for less than 120 days, then he is non-resident. Now, if both of them are non-resident, Miss Aparna is also non-resident, Miss Dimple is also non-resident. So there is an exemption under section 47 which says that if one non-resident transfers to another non-resident rupee denominated bond of Indian companies issued outside India, then capital gains is exempt under the income tax law. So this is exempt under section what? Under section 47. I hope it is clear to all of you. Now the next question is based on the grandfathering clause which of what? Of the income tax law, okay, of capital gains. There are two people over here. One is Rajan and one is Rajan's brother. Rajan purchased 300 shares in ICAI Limited on 12th Jan 2017 at a cost of 2,500. The fair market value on 31st Jan is 1,800. Whenever the fair market value on 31st Jan 2018 will be given, remember the grandfathering clause is applicable to you because there is no other implication of this date except the grandfathering clause. Now Mr. Rajan sold all the shares of ICAI Limited on 15 July 2023 for 3,200. Okay. So first of all, we will compute the capital gains of Mr. Rajan. At the end, it is written that STT was paid at the time of purchase and sale. Therefore, section 112A is applicable. If 112A is applicable, 1 lakh capital gain is exempt, above 1 lakh 10% tax. And if it is purchased before 31st Jan 2018, then grandfathering clause is applicable. So Mr. Rajan selling price is 3,200. Okay. Now, how to compute the cost? For computing the cost, you have to follow a long step. Okay. What is that long step? First, actual cost. This is step number 1, actual cost. Then you compare the fair market value on 31st Jan with the selling price, whichever is lower. Whichever is lower will become point number 2, and therefore 1,800 is point number 2. Then 1,800 and 2,500, whichever is higher, and that will become your actual cost. So the cost of Rajan is how much? 2,500. So 3,200 minus 2,500, 700 is the cost, multiplied by 300 shares. So 2,10,000 is the long-term capital gains of Mr. Rajan. Now let's talk about Rajan's brother now. Rajan's brother has also purchased 600 shares on 25th Jan at a cost of 1,900. The FMV of these shares were 2,400. Okay. Now, Mr. Ravi sold all the shares for 1,700. So, for Ravi, the selling price is 1,700. How the cost will be computed? Same way. The cost will be first, step number 1, actual cost. Then compare with lower of the two. The lower of the two is what? The lower of the two is 1,700 or 2,500, whichever is lower, and therefore the answer is 1,700. Now we will compare 1,900 and 1,700, and whichever is higher will become your cost. Therefore, in case of Ravi, the cost is 1,900. So for Ravi, there is a loss of 200 rupees, and therefore 200 into 600 shares will come to 1,20,000 rupees loss for Ravi. Can you see this? I hope it is clear to all of you. Okay, it's a very simple question on grandfathering. Apply the grandfathering provision. How to compute cost in case of grandfathering? Do not forget that. Step 1, cost of acquisition. Step 2, lower of FMV on 31st Jan compared with selling price. Whatever comes in step 2, compare with step 1, whichever is higher will become your cost of acquisition. Okay, and accordingly compute the capital gains. Let's move on to the next question. That is the difficult one of capital gains. There are two persons over here, Mr. Vishal and Mr. Guha. Both of them sold their residential property in Pune for 3 crore and 4 crore respectively in Jan 2024. The house property was purchased by them for 25 months ago. It means both the properties are long term. We should know that house property becomes long term after 24 months. Therefore, for Vishal and Guha, we need to compute the capital gains. So, Vishal is selling the property for 3 crore and Guha is selling the property for 4 crore. Now, the index cost of acquisition of both is given as 1 crore and 1.75 crore. So, for Vishal, the index cost is 1 crore. For Guha, the index cost is 1.75 crore. Therefore, I got the capital gains as 2 crore and 2.5 crore. Now, very important point comes over here. The important point over here is Vishal's capital gain is 2 crore. Therefore, do you remember, if your long-term capital gain is up to 2 crore rupees, then as per section 54, you have an option to buy 2 houses once in a lifetime. Remember that? So, Vishal will take that advantage. Now, Vishal is purchasing 2 houses. One in Delhi, one in Agra of 70 and 80 lakhs. Therefore, Vishal will take the benefit of 2 houses once in a lifetime because his capital gains is up to 2 crore rupees. But Guha will not be able to take the advantage of both because Guha's capital gains is 2.25 crore, which is exceeding 2 crore rupees. Therefore, Guha will take the advantage of only 1 house. So, Guha is buying how many houses? Guha is buying 2 houses, 180 lakhs, 175 lakhs. So, only the advantage of 80 lakh house he will take, the advantage of 75 lakh house he will not get. Okay. Apart from that, both of them are also investing 30 lakh in NHAI and 30 lakh in RECL, total 60 lakhs. But unfortunately, only 50 lakh is allowed under 54 EC. So, out of 60 lakh, 50 lakhs will be allowed to them as an exemption. Okay. With that, Vishal's capital gains comes to 0 and Guha's capital gains come to 95 lakhs. And that is the answer over here. You can check over there. The answer number 3. Okay. Now, let's move on to the next question. Question number 5. Income from other source. Simple question. Okay. Let me read the question. P is a salaried employee. On 1st June 2023, he gets a gift of house property situated in Mumbai of 80 lakh rupees stamp duty value from Q. Okay. So, I am a salaried employee. I am P. I am getting 80 lakh rupees worth of house as a gift from somebody. Okay. On 2nd of August 2023, P gets a gift of house property in a small town near Pune. Stamp duty value is 50,000. So, I got another house of a stamp duty value of 50,000 as a gift. On 3rd September 2023, P also gets a gift of house property in a small town near Kanpur from R. The stamp duty value is what? Rupees 1 lakh. What will be the tax implication in the hands of P, Q and R, assuming they are not related to each other? Okay. So, first is what? 80 lakhs. So, if you are receiving a house of 80 lakh rupees from someone with for free as a gift, then whether it is taxable? Yes, it is taxable. If you receive a house property, land and building of more than 50,000 rupees stamp duty value, whose stamp duty value is more than 50,000 rupees, it is taxable. Therefore, the first one is taxable. What about the second one? Second one is not taxable because the amount is not exceeding 50,000 rupees. What about the third one? The third one is also taxable because the amount is exceeding 50,000 rupees. Therefore, in all, how much will be taxable? How much? 81 lakhs will be taxable in the hands of P. And what is the taxability in the hands of Q and R? The people who are giving them, Q and R, no capital gain shall arise in the hands of the transferor, because as per section 47, there is no capital gain shall be chargeable on transfer of a capital asset by way of a gift. If I give as a gift to somebody, then the giver is not liable, the transferor is not liable to tax, the receiver is liable to tax. I hope it is clear to all of you. Okay. Now, let's move on to the next question. Mr. Anjan, a property dealer, sold a flat in Mumbai. The stamp duty value of which is how much? 2 crore rupees. And for 1.8 crore to his friend, Mr. Ashwin, a college lecturer. So, who is Anjan? Anjan is a property dealer. He is selling the flat for 1.8 crore and the stamp duty value is 2 crore. Therefore, here the provision of what? 43 CA will apply. What will apply? 43 CA will apply to Anjan because Anjan is selling the property as a property dealer. Therefore, selling price for Anjan will be 2 crore and the cost for Anjan, which was purchased 1 year back, is 1.5 crore. Therefore, 50 lakh rupees for Anjan will be what? Will be PGBP income. What about Ashwin, his friend? His Ashwin will be liable for IFOS because he is purchasing the property of 2 crore rupees for how much? The property of 2 crore rupees for how much? For 1.8 crore. Therefore, 20 lakhs will be taxable as IFOS in the hands of Ashwin. Now, let me speak few things over here, which is very important. Why 43CA is applicable? Because the difference between the stamp duty value and the sale consideration is greater than 110%. Then only 43CA is applicable. Otherwise, it is not applicable. You compare the difference between the sale consideration and stamp duty value, it is more than 110%. Therefore, 43CA is applicable. Similarly, why Mr. Ashwin is liable for IFOS? Because the difference is greater than 100% and the difference is also greater than 50,000 rupees. For Ashwin, both the conditions should be fulfilled. It should be greater than 110% also. It should be greater than 50,000 also. Then only it is taxable. So, in case of Ashwin, 20 lakh will be taxable. I hope it is clear to all of you. So now let's go ahead with the next chapter, and the next chapter is chapter number 6, simple MCQs of the chapter of clubbing. Now, what are the questions which are given on clubbing now? There is one question which is given on clubbing of income. This is the chapter of income of other person included in assessee's total income. This is nothing but clubbing of income only. Okay. Now, let's read the question. Mrs. Kavita, wife of Mr. Sundar, is a partner in the firm. So, who is the partner in the firm? Kavita is a partner in the firm. Now, her contribution of capital in the firm is around 5 lakh rupees, which included 3 lakh rupees received as a gift from his husband. So, out of 5 lakh rupees, 3 lakh rupees is given as a gift from the husband. Now, it's a very simple question. If 5 lakh rupees is invested by the wife and out of that 3 lakh rupees is given by the husband, it means 60% is given by husband only. Therefore, whatever remuneration and interest is received by Kavita ji, 60% should be taxable in the hands of husband. Correct or not? I hope it is clear to all of you. Now, on 2nd April 2023, she further invested 1 lakh rupees out of the gift received from Sundar. Now, remember always, for the purpose of clubbing, the amount which is received during the financial year is not included. Whatever is the opening balance on 1st April 2023, only that much is used for clubbing. The amount which is used in the current year will not be used for the purpose of clubbing. So, the amount which is received on 2nd of April 2023, 1 lakh rupees, that will not be used for clubbing. Only how much will be used for clubbing? Only 3 lakh rupees will be used for clubbing. So, let's see. The firm paid interest of 60,000. So, out of 60,000, 60% will be taxable in the hands of Sundar. 36,000 will be taxable in the hands of Sundar. Correct? And share of profit fully exempt. That is exempt in the hands of everybody. Correct or not? I hope it is clear to all of you. Right? And 24,000 of the interest will be taxable in the hands of what? Mrs. Kavita. And share of profit is exempt. Therefore, share of profit exempt, 36,000 taxable in the hands of husband Sundar and 24,000 taxable in the hands of Mrs. Kavita, the wife. Okay. Remember, the amount which is introduced during the current financial year, that is after the 1st April 2023, will not be included in clubbing. Only the opening balance is considered for the purpose of clubbing. Be very careful. Okay. Now, let's move on to the next chapter, and that is deduction under chapter 6A, simple MCQ, MCQ number 1. Let's read this MCQ which is on ATM. ATM deduction. The Gamma Limited has distributed dividend on 30th June of dividend of rupees 130 lakh to the shareholder. During the financial year 2023-24, Gamma Limited has received a dividend of net 108 lakhs. It means what is the gross dividend? How much TDS is deducted on dividend? The TDS which is deducted on dividend is 10%. Therefore, the gross dividend will be 120 lakhs. How much is the gross dividend earned by Gamma Limited? It is 120 lakhs. Further, the Gamma Limited has also earned dividend of how much? 30 lakhs from foreign company. Okay. That is also earned by Gamma Limited, and therefore the total is 150 lakhs which is earned by Gamma Limited. Okay. Now, out of that, how much is distributed on 30th June? That is before the due date. By when it should be distributed so that a deduction is allowed under ATM? A distribution should be made 1 month prior to the due date of filing of return. So, if the distribution is made 1 month prior to the due date of filing of return, you can do the deduction under section ATM. So, you are distributing well before time, therefore 130 lakhs will be reduced, and therefore the answer over here is 130 lakhs will be the deduction which will be allowed to the assessee. I hope it is clear to all of you. Okay. Now, let's move on to the next question. Medium MCQ, deduction from gross total income, medium MCQ. In previous year 23-24, Mr. Ganguly, a resident individual aged 60 years. What is the age of Ganguly? He is resident first of all. His age is 60 years. Okay. Now, he is earning the following income. Which income? Income from profession, 1,45,000. Winning from card games, 1,50,000. He has also earned some interest on FD, 40,000. He has also earned some interest on saving account, 9,000. Therefore, his total income is how much? Gross total income is 3,44,000. Now, he has also invested 1,50,000 in PPF. Now, the first thing that I would like to say is his interest on FD and interest on saving is 49,000, and because he is a senior citizen and he is resident, he will directly get this 49,000 as a deduction, that because up to 50,000 deduction under 80 TTB is allowed. Okay. Now what is left? Now only two incomes are left. Which incomes? Because these two are already deducted as 49,000. Both the interest is 49,000 and that will be allowed as deduction under what? Under 80 TTB. Now let's talk about let's talk about profession income and card game. Remember, card game is not eligible for chapter 6A. Card games are directly taxable at 30%. Therefore, you will not get deduction on this 1,50,000 rupees. You will get deduction of only 1,45,000 because that is the only balance income. Therefore, here you will not get 1,50,000. You will get only 1,45,000. Therefore, eventually your income is only 1,50,000 rupees. That is your card games. Rest all is getting deductible under chapter 6A. I hope it is clear to all of you. Is it clear? Now, let's move on to question number 2 of chapter 6A, medium MCQ. Okay. Question number 2. Nikhil, an individual. His age is 35 years and he has incurred the following expenses for the benefit of his family. His family means he himself, his wife and his dependent children. And he has also incurred some money he has also incurred on his parents, that is father and mother. Father age is 80 years, mother age is 76 years. Now, what he has incurred? He has incurred some medical insurance premium which is paid by check. He has also incurred preventive health checkup which is paid in cash. It is allowed. You can make the preventive health checkup in cash also. And he has also incurred some medical expenditure also for those people for whom he has not taken the mediclaim. Because for whom you have not taken the mediclaim, you can also claim the deduction of medical expenditure also. Now, for his family, first of all, let's see. For his family, he has incurred 20,000 rupees in mediclaim, 7,000 in this and 2,000 in this. So, this is not allowed obviously because it is only allowed for senior citizens and not for everybody. Okay. So, here you will get only 25,000, total of 27,000 restricted to 25,000 only. Okay. Now, for the benefit of his father, he can get 32,000 rupees. What? Medical expenditure, because he has not taken the medical insurance of his father. So, he can claim 32,000 rupees for his father also. And for his mother, he has taken mediclaim, so he can claim this, and for mother he cannot claim medical expenditure. He can claim what? The mediclaim. But the total of these two should be maximum 50,000. Okay. So total of these two should be maximum 50,000. So this is 32,000 and this is 6,000. So this will be subject to what? 38,000 deduction you will get over here and 25,000 over here, and therefore total will be 63,000 rupees. Okay. What is not allowed? Not allowed is 2,000 out of this is not allowed because preventive health checkup is allowed only to the extent of 5,000 rupees and total also 25,000 is max. And this is not allowed because if you are already having a mediclaim, then you cannot claim a medical expenditure. For father, medical expenditure is allowed because father does not have a mediclaim. For mother, mediclaim is allowed because for mother does not have a medical expenditure. Okay. So this is how you will compute the deduction under chapter 6A. I hope it is clear to all of you. Now, next simple MCQ of assessment of various entity which is on tonnage taxation company. I'll tell you the crux of this question. Suppose the tonnage taxation company is eligible for tonnage taxation for a period of 10 years. Okay. Now there are two tonnage taxation company. One is X company, one is Y company, and one company has an unexpired period of 8 years. Another company has an unexpired period of 6 years. When both of them gets merged now, the law says that the merged entity will get the benefit of higher number of years. Okay. So if one entity was unexpired for 8 years, another entity was unexpired for only 6 years. And if both of get merged and does an amalgamation, then the merged entity will get the benefit for how many years? Will get the benefit for, tell me, 8 years. This is what this small question is all about. You can go through it. Okay. I hope it is clear to all of you. Next one, assessment of various entities. Next question. Okay. Now, this is a beautiful question. It's a lengthy question. Mr. Hari has an income of 52 lakhs under the head PGBP. So, how much income is there in PGBP? 52 lakhs. One of his business is eligible for deduction under 80IA 100%. Okay. So, one of his business is eligible for deduction under 80IA and Mr. Hari is an individual. Okay. The profit from such business included in the business income is 35 lakhs. So how much is the ATIA business? ATIA business is the 35 lakh rupees. Now we need to compute the tax liability assuming he exercises to shift out of the default tax regime. He does not want to follow the default tax regime. It means he wants to follow the old regime. Now if he wants to follow the old regime, and if he is an individual, and if he is claiming a profit link deduction, and if his adjusted total income is greater than 20 lakh rupees, then he has to follow AMT. He has to follow AMT. So we need to make two calculations over here. Okay. First, as per regular provision. What will be the tax as per regular provision? PGBP 52 lakhs. In regular provision, he will get deduction of 35 lakhs, and on 17 lakhs, he will compute tax as per the normal provision. Okay. 2.5 lakh, 5 lakh, 10 lakh, etc. Now, in AMT, he has to compute adjusted total income. What is adjusted total income? It is nothing but total income plus the chapter 6A profit link deduction which you have claimed, and therefore the adjusted total income will come to 52 lakhs. What is the tax rate for adjusted total income? It is 18.5%. Plus he will also be liable for now surcharge because the adjusted total income exceeds what? Exceeds 50 lakh rupees. Therefore surcharge of 10% and cess of 4%. Therefore this will come to 11 lakh 528, which is nothing but 11 lakh 530, and this is the answer to this particular question. Check it please. I hope it is clear to all of you because it is whichever is higher, and therefore this answer is whichever is higher. Is it clear? I hope it is clear to all of you. Let's move on to the next chapter, which is assessment of trust, institution, political party and other small entities like REIT, InvITs, etc. Securitization trust, investment fund, etc. etc. The first question, dividend received by a real estate investment trust, that is business trust, from SPV and distributed to unit holder is. What happens for the dividend? Remember, when a business trust receives dividend from the SPV, it is always exempt. In the hands of business trust, it is always exempt. In the hands of investor, it depends. If the SPV has taken 115BAA, then it is taxable here. If the SPV has not taken 115BAA, then it is exempt here. Check please. It is always exempt in the hands of REIT. In the hands of REIT, dividend is always exempt. And exempt in the hands of unit holders only if SPV does not exercise the option of 115BAA. If SPV exercises the option of 115BAA, then it is taxable in the hands of investor. If SPV does not exercise the option of 115BAA, then it is exempt in the hands of the investor. I hope it is clear to all of you. Okay, let's move on to the next question. Question number 2. Kamala Charitable Trust, registered under 12AB, having its main objective as medical relief, earned income of 2 lakh rupees as interest on bond issued by local authority, and agricultural income of 4 lakh during the previous year 23-24. Which of the following statement is exempt and which of the following statement is correct? Remember, there are two incomes which are earned by this particular trust. Let me say the two incomes first of all. 2 lakh rupees is earned from a bond which is issued by local authority. Now this income is generally exempt under section 1015 generally, and agriculture income is exempt under section 10.1. Now what will happen to the trust? Remember, for trust there is a special section 11.7 which says that no exemption of section 10 will be allowed to trust except 10.1 and certain more other section 1023C, 1023AEF, etc. There are a few more sections which are added by Finance Act 2023. Moral of the story, if you are a trust, you will not get any exemption of section 10 except the agricultural exemption. The agricultural exemption you will continue to get. Apart from that, you will not get any other exemption. So by that logic, this first exemption of 1015 will not be allowed to trust, but the second exemption will be allowed to trust. And therefore, the answer to this question is answer number 4. You can check it please. The trust can claim exemption under 10.1. However, 1015 is not available to trust if the trust is claiming exemption under section 11 and 12. I hope it is clear to all of you. Okay. Now, let's move on to the next question again, which is on medium MCQ of chapter number 10, chapter 10 medium MCQ, and which is again on chapter of charitable trust. Okay, MCQ number 1. Now, for the previous year ended 31st March 2024, a public charitable trust registered under 12AB. It's a trust registered under 12AB. Okay, and it is deriving an income of 10 lakh rupees from the property held under trust. Okay, so I am writing 10 lakhs over here in the income statement. It is also deriving 15 lakhs rupees from the public contribution, out of which, so 15 lakh rupees is the donation which it has received, out of which 8 lakh was applied for charitable purpose, 4 lakhs towards repayment of construction of loan. The amount of 4 lakh was not claimed as application in earlier years. Okay, so now it's a very simple question, nothing great as such. First of all, the trust has earned income of 10 lakh rupees. So I'm writing 10 lakh over here. Second, the trust has also received 15 lakh donation. So I'm writing 15 lakh over here. So 25 lakhs is the total income. From that, I will get flat 15% exemption first of all. Then trust has applied 8 lakh rupees for the purpose of the objects of the trust. So I will get that as an application. Then trust has repaid 4 lakh rupees loan and that was not claimed as expenditure earlier. It was not claimed as application earlier. So trust can claim that as a repayment of loan is allowed as a deduction. So this 12 lakhs will be allowed as deduction and therefore the answer will come to 9.25 lakhs and therefore the answer to this question is answer number 2. I hope it is clear to all of you. Okay. Now let's move on to question number 2 of the trust. Again, it's a very beautiful question on trust. Okay. Now during the previous year 23-24, Sarva Seva, a charitable trust, made a voluntary contribution, not being corpus donation. So the trust has made what? A voluntary contribution, not a corpus donation. Anyways, corpus donation, if you do, it is not allowed as a deduction. Only voluntary donation is allowed as deduction. Corpus donation is not allowed as deduction. Now, the question is, it made a voluntary donation to another charitable trust registered under 12AB out of its current year income. Is it allowed? Yes, allowed. Why not allowed? If a trust gives donation to another trust, voluntary donation to another trust registered under 12AB out of its current year income, not out of past income, out of its current year income, it is allowed as deduction. Similarly, it gives donation to another educational institution registered under 1023C out of its current year income. Yes, that is also allowed. If a trust gives donation to another trust or if a trust gives donation to another institution registered under 1023C, then that is allowed out of its current year income. But remember, there is one amendment made by Finance Act 2023. Now the donation will be allowed only to the extent of 85% of the donation, not more than that. If you make a donation of 10 lakh rupees, only 8,50,000 will be allowed as deduction, not more than that. I hope it is clear to all of you. The third one, to another charitable trust out of its accumulated income, not allowed. Accumulated income donation, if you give, then that is not allowed as a deduction. Therefore, the answer to this question is point number 1 and 2, and therefore the answer to this question is point number 3. I hope it is clear to all of you. Now, the next question is slightly incomplete in your book. That is the sheet which I have shared with you. It is slightly incomplete. So first of all, please complete this sheet and then only we'll be able to address this because it's a beautiful question. Very, very, very beautiful question. So there are 3 columns. First of all, you are supposed to make. One is the column of investment fund you are supposed to make. Second, the column of REIT. Third, the column of securitization trust. 5% is the stake in the investment fund. 10% is the stake in the REIT and 7.5% is the stake in the what? Securitization trust. Now, what is the rental income from? Directly. It is 10 lakhs over here. So you write down 10 lakhs over here. There is one item you have to add over here. Profit from business is 5 lakhs and 6 lakhs. There is no profit from business here. Okay. And then there are 2 lakhs over here, 2.5 lakhs over here, 12.5 lakhs, then 8 lakhs over here, 1 lakh, and these items will be cancelled. Strike off these items. Okay, so you have to make these changes first of all because the question is incomplete. I'm really sorry for that. Okay, now let me read the question now. Mr. B has been holding 10% units in real estate investment trust. So in REIT you are holding how much? In REIT you are holding 10% stake and 7.5% in what? In securitization trust, and in investment fund you are holding what? 5% stake, and the units are more than 15 months old. Okay, so this sentence has some relevance in the question. You will come to know when you solve the question. The following incomes are earned by trust or fund. So these are the incomes which are earned by trust and fund. Now what is our question? The question is as follows. Pay attention. What would be the total income of Mr. B? We need to find out the total income of Mr. B. Okay, we need to find out Mr. B's total income. So very good question. Assuming that apart from the share of above income, Mr. B had only long-term capital gains of 2,70,000. So Mr. B also had a long-term capital gains of 2,70,000. So let me talk about column wise one by one. First of all, I will talk about investment fund. So let me talk about investment fund first of all. So in case of investment fund, the very first income which is earned by investment fund is profit from business. Remember, whatever profit is earned by investment fund from business, that is directly taxable by the fund only. Investor is not liable to pay tax. Investor is exempt with that. So investor will not pay tax on this income. Okay. Now, what about other income? Other income will be taxable in the hands of investor. Like The other income of 2 lakh rupees is the total income of the fund, out of which how much is held by Mr. B? 5%. So 5% of 2 lakh will come to 10,000 rupees. So 10,000 will be attributed to Mr. B. Okay. What about this loss of long-term capital loss? Long-term capital loss will also be attributed to Mr. B because Mr. B is holding the shares, holding the units for more than 12 months. If the units are held by the investor for more than 12 months, then it should be attributed to the investor. So therefore, this loss, 5% of this loss will also be attributed to the investor. So 5% of this comes to 60 to 500 rupees. This will also be attributed to the investor. Okay. So what are the two incomes which are there so far from the fund? 10,000 positive and 62 to 500 negative. Apart from this, Mr. B also has a 2,70,000 rupees long-term capital gains that will also be taxable in the hands of the investor. So now investor can set off this long-term capital loss against this long-term capital gains, and this 2,17,500 rupees will be considered to be the income of what? Income from the fund which is taxable in the hands of the investor. Okay. Now let's talk about the other incomes. That is from the REIT. From REIT, they are earning 10 lakh rupees directly. So whatever rent is earned by the REIT, that is exempt in the hands of the REIT, but in the hands of the investor it is taxable. How much taxable? 10% will be taxable. So 1%, 10% of 10 lakh will come to 1 lakh. So this 1 lakh will also be taxable in the hands of investor. Okay. What about the income from special purpose vehicle? That is 8 lakh rupees this, and then 1 lakh rupees dividend, 1 lakh rupees other income which is also earned by the invest REIT over here. Okay, let's talk about that. Interest income from special purpose vehicle. Now that is also taxable. That is also taxable in the hands of the investor. So 10%. So whatever interest you receive from this SPV, that is exempt in the hands of REIT but taxable in the hands of investor. In the hands of REIT it is exempt, in the hands of investor it is taxable. Therefore 10% of that comes to how much? 80,000 rupees. And other incomes not in the nature of dividend, and whatever is the other income, on that the REIT will pay tax at MMR, REIT will pay tax at MMR, and investor will not pay a single penny as tax. Investor will not pay a single penny as tax. So this 1 lakh rupees is exempt in the hands of investor. So from REIT, two incomes are coming: 1 lakh rupees rent and 80,000 rupees of interest income. And the third one, securitization trust. Whatever is the profit which is earned from securitization trust, out of that 7.5% will be taxable in the hands of the investor. So if I total all of them, I will get the answer as 4,42,000 rupees 42,500 rupees. That is the ultimate taxable income which is taxable in the hands of Mr. B. I hope it is clear to all of you. Now let's move on to the next question. A REIT. Question number 2. A REIT has distributed 2 crore to its unit holder, which comprises of the following. First, rental income from the real estate property, 80 lakhs. What is the treatment of this? It is exempt in the hands of the REIT, taxable in the hands of investor. Therefore, the REIT has to deduct the TDS. Okay. Second, interest income from SPV. What is the treatment of this? Exempt in the hands of REIT, taxable in the hands of investor. Therefore, the REIT has to deduct the TDS. Okay. Third one, dividend income from special purpose vehicle, 40 lakhs. And one important information is given. The special purpose vehicle A Limited does not exercises the option of 115BAA. Okay. The special purpose vehicle does not exercise the option of 115BAA. So now listen carefully. So it is exempt in the hands of REIT, and because the SPV does not exercises 115BAA, it is exempt in the hands of the investor also. So in the hands of the investor also it is exempt. Okay. What about capital gain on disposal of assets? So REIT will pay tax on this 30 lakhs and investor will not pay tax on this 30 lakhs. Therefore, the answer to this question is point number 4 and point number 5. Okay. So what is point number 4? Only income referred in point number 4 is taxable in the hands of REIT. Why? Because the first one is exempt in the hands of REIT, taxable in the hands of investor. Second is also exempt in the hands of REIT, taxable in the hands of investor. Dividend is also exempt. Only the fourth one is taxable in the hands of REIT. Okay. And income referred in point number 1 and 2 is taxable in the hands of unit holder. And because it is taxable in the hands of unit holder, 1 and 2 will also be tax subject to what? So will also be subject to TDS. Okay. And income referred to in 3 is exempt in the hands of both. Why? REIT, though it is always exempt, investor also exempt, because the SPV is not following 115BAA. So it is exempt in the hands of investor also. Okay. So what is the ultimate treatment? That I have already told you with the help of the original reading of question. When I have read the original question, at that time itself only I have told you the entire discussion of this particular point. I hope it is clear to all of you. Okay. So let's move on to the next chapter, that is chapter number 12, medium MCQ, that is taxation of digital transaction, which is on equalization levy. Let's talk about it. ABC and company and PQR company, these are the two non-resident entities based in country A and country P respectively. And both the entities own and operate an electronic facility, that is they operate a website through which they effect organic sale of organic products manufactured by them. Okay. So both of them have their own website through which they sell some product. Okay. Now, therefore, here the equalization levy of 2020 will apply because 2016 equalization levy is applicable for online advertisement. That is not applicable for sale of goods. Okay. Now, it is applicable when? Do you remember that? When the receipts is from the sale of organic product to person resident in India, yes, that is covered. Okay. And also if it is sold to other persons, person resident in other parts of the world, but they are using IP address located in India, that is also covered. Okay. So, 138 lakhs. Let's talk about ABC first of all. ABC is selling to how much to residents? 138 lakhs to resident. And to non-resident 285 lakhs. Out of that 68 lakhs, 63 lakhs, out of 285, 63 lakhs is sold to persons outside resident in India, but they are using IP address located in India. Therefore, that will be covered. Now, the total of 138 plus those people who are using Indian IP address is 201 lakh. Now, because it is 2 crore or more than that, therefore, here equalization levy will be applicable 2% of 2020. Okay. For applying 2020 equalization levy, the turnover should also be at least 2 crore rupees. Otherwise, 2020 equalization levy is not applicable. Okay. Now, one more condition is there for applying 2020 equalization levy, that the entity should not have a P in India. And yes, they do not have a P in India. Now, let's talk about PQR. PQR is selling to Indian residents 126. This will come. Out of 377, only 73 is sold to those people who are using Indian IP address. Therefore, the total comes to 199. Therefore, equalization levy will not apply in this case. Okay. Therefore, in case of ABC, equalization levy will apply. In case of PQR and company, equalization levy will not apply. I hope it is clear to all of you. Okay. Now, let's move on to the next question. Mr. Rajesh, a resident Indian, is an employee of Mrs. ABC Limited. Okay. Which is in Bangalore. In addition to the salary income from Mrs. ABC, he also earns interest from FD. Mrs. PQR Inc., a foreign company not having a P in India, whose gross receipts equivalent to 1.8 crore, rendered online advertisement to Mr. Rajesh. Okay. For which Mr. Rajesh made a payment of 2 lakh rupees in financial year 23-24. Now the question is Mr. Rajesh liable for equalization levy? And the answer is no. I'll tell you the reason. 2016 equalization levy is not possible. Why? Because 2016 equalization levy is applicable only if you make the payment for business on profession. And Mr. Rajesh is not a business assessee. Therefore, 2016 equalization levy is not possible. 2020 equalization levy is also not possible. Why? Because for 2020 equalization levy, the turnover has to be at least 2 crore rupees, which is not. The turnover is less than 2 crore rupees. Okay. The turnover of that foreign company should be at least 2 crore rupees. If it is less than 2 crore, then 2020 equalization levy is not applicable. Therefore, the transaction is not subject to equalization levy, and therefore the answer to this question is point number 7. I hope it is clear to all of you. Okay. Now let's move on to one of the most important topic of CA final, that is TDS. First of all, we'll talk about the simple MCQs of TDS. First, Mr. Valish is an employee and he is paying a rent of 50,000 rupees per month. Okay. So is 194I applicable? 194I is not applicable to those individuals who are not doing business. 194I is applicable to individual HUF only if their business turnover of last year is more than 1 crore and profession turnover is more than 50 lakhs. Therefore, 194I is out of question. What about 194IB? IB may be applicable, but here even IB is not applicable because for IB, the rent per month should exceed 50,000 rupees. It is exactly 50,000 rupees. Therefore, here IB is also not applicable. I hope it is clear to all of you. If the rent would have been exceeding 50,000 rupees, then I would have applied the TDS provisions of 194 IB. Here 194 IB is also not applicable. Okay. I hope it is clear to all of you. Now next question, medium MCQ, question number 1. Now ABC Limited took on sublease a building from Mrs. Janvi from 1st July. Okay. At 20,000 rupees per month. So for 9 months, they are paying rent on building of 20,000 rupees per month. So that will come to 1,80,000. Now they also took from 1st October machinery on hire at 15,000. So for 15,000 rupees machinery rent they are paying for 6 months. So that comes to how much? That comes to 75,000. Now in 194I building also comes, in 194I plant and machinery also come, and you have to check the aggregate limit of 2,40,000. That is, you have to consider building as well as plant and machinery both and then compute 2,40,000 it exceeds or not. So in this case it exceeds 2,40,000. 2 lakh plus 75,000, 1,80,000 plus 75,000. It is 2,55,000, therefore TDS is applicable. But remember, on building the TDS will be 10% and on plant and machinery the TDS will be what? 2%. Okay. Remember, always aggregate limit has to be seen in 194I. Always aggregate limit has to be seen. Okay. I hope it is clear to all of you. Next question number 2. Kulan and LLP engage in manufacturing business, withdraw from its bank 125 lakhs by cash. Each individual withdrawal does not exceed 2 lakhs in the financial year 23-24. The purpose of withdrawal from the bank is for buying agriculture produce. It doesn't matter for what purpose you are withdrawing. It's very simple. If you withdraw more than 1 crore rupees and you have been filing the return regularly, you have filed the return of the last 3 years. Okay. And if you withdraw more than 1 crore rupees, then on excess amount, that is on 25 lakh, 2% TDS will be applicable under section 194N. Yes, if the other person does not withdraw what? If the other person has not filed the ITR for the last 3 years, then the limit for that person is above 20 lakhs. Above 20 lakhs up to 1 crore, 2%, above 1 crore it is 5%. But here it is very clearly written, the SSC has been filing the returns regularly. The Kunal and company always file its return before the due date. Therefore, the threshold over here will be 1 lakh, above 1 lakh, 2% TDS will be applicable. Okay. I hope it is clear to all of you. Now, next, let's come to the TDS difficult question. Mr. Sanjay is a salaried individual, pays brokerage of 40 lakh rupees to Mr. Harish. Now, please tell me, if a salaried individual pays a brokerage, whether 194H will apply, 194H will not apply. Why? Again, a similar question has come earlier. For 194H to apply to individual, first of all, the individual should be a business SSC and the last year business turnover has to be greater than 1 crore or the last year profession turnover should be greater than 50 lakhs. So the second option is 194M applicable. 194M also not applicable. Why? Because the payment should exceed 50 lakh rupees in the entire financial year. Therefore, 194M also not applicable. Now, let's talk about his father now. His father, Mr. Hari, is also a retired pensioner. He is also not doing business. He is making a contract payment of 15 lakh, then 25 lakhs, total 40 lakhs, and then 12 lakhs again, total 52 lakhs for construction of his residential house. Whether TDS is applicable in his case. Again, his father is not a businessman. So 194C is not applicable. But is 194M applicable? The answer is yes. In case of his father, 194M is applicable because the aggregate payment exceeds how much? 50 lakh rupees. It is 52 lakh rupees in case of his father. Therefore, 194M will be applicable. 5% TDS will be applicable in case of his father. Okay. His father will deduct 5% TDS. I hope it is clear to all of you. Next one. Mr. Hari is an interior decorator declaring a profit under 44 ADA in previous year 23-24 and earlier previous year also. It means his income is what? His income is less, his turnover is what? Less than 50 lakh rupees, right? So his turnover is definitely less than 50 lakhs because he is following what? He is following what? He is following 44 ADA. Mr. Hari has to pay a brokerage of 10 lakh to Mr. Lal to buy a residential house and rupees 50 lakhs to Mr. Sham, a contractor for reconstruction of residential house. Whether TDS is applicable? See, 10 lakh is paying to as a brokerage. 194H is not applicable. 50 lakh is paying as a contractor. 194C is also not applicable because his last year turnover is less than 50 lakhs. Because his last year turnover is less than 50 lakhs, these provisions are not applicable. But the question is whether 194M will apply. Even 194M will not apply. Why? Because in case of Mr. Lal, the payment is only of 10 lakh. And in case of Mr. Sham, the payment does not exceed 50 lakhs. It is exactly 50 lakhs. Therefore, TDS is not applicable. No TDS are attracted in case of Mr. Hari in respect of payment to made to Mr. Lal and Mr. Sham. In case of Mr. Lal, why it is not applicable? Because it is just 10 lakhs. In case of Mr. Sham, why it is not applicable? Because it is exactly 50 lakhs. For 194M to apply, it should exceed 50 lakh rupees. Exact 50 lakhs TDS is not applicable. I hope it is clear to all of you. Okay. Now, let's move on to the next chapter, that is simple MCQs of income tax authorities. The very first thing over here is on section 271 AAB, that is the penalty for search and seizure. Now, let's read the question. In course of a search operation under 132 in the month of May. So, in the month of May, search was conducted. Mr. Akash makes a declaration under 132(4) on earning of income not disclosed in respect of 22-23. He also explains the manner in which he has derived the income. He pays the tax and interest and declares such income in the return filed by him in the month of July. Is penalty leviable in this case? How much? Remember, suppose if search is happening in the month of May and during the course of search, if you declare a statement, if you make a declaration in a statement under 132(4), how your income is disclosed and you prove that income belongs to the last year or the current year, which can be called as specified previous years. Last year is called as specified previous year, and even current year in the year which search is conducted, that year is also called as specified previous year. These 2 years are called as specified previous year. So, if during the course of search, if you give a statement in section 132(4) and disclose the income and pays the tax and interest and file the return also on time, then also the department will take a penalty of 30% of undisclosed income. Okay. 30% of undisclosed income under section 271 AAB. And if you violate any condition which I have told you, you did not disclose the income, you did not file the statement, you did not pay the tax or interest, you did not file the ITR. If you fail to fulfill any of the condition, then there will be a penalty of 60% of undisclosed income. But in this case, the assessee is fulfilling all the conditions. Therefore, the penalty will be only 30% of undisclosed income. I hope it is clear to all of you. Okay. The next question is a continuation of that. He does not disclose the such income in the return of income. Everything is same, but he does not disclose such income in the return of income. He is violating one of the condition. Therefore, it is 60% of tax of your income. Okay. So here all conditions are fulfilled. So 30%. Here one of the condition is violated. So it is 60% of undisclosed income. That's the only difference between these two questions. I hope it is clear to all of you. Okay. Let's move on to the next question. Income Tax Authority medium MCQs. The assessing officer within the jurisdiction surveyed a popular cafe at 1 a.m. in the night for the purpose of collecting information which may be useful for the purpose of Income Tax Act. The cyber cafe is kept open for every business day between 2 p.m. to 2 a.m. He impounded and retained in his custody books of accounts and other documents inspected by him after recording his reasons for doing so for 12 days. Which of the following statement is correct? Okay. Now my question to all of you is, can a survey be done in the night? See, generally a survey should be done after sunrise but before sunset. If the department wants to enter any place, they can enter after sunrise but before sunset. But there is a provision which says that if your business hours is in night, then the department can enter in night also and they can impound your books also. There is no harm in that. So here the business hours is 2 p.m. to 2 a.m. and the department is entering at 1 a.m. That is 1 hour before the business closes. Therefore, it's a valid action. The assessing officer's action in entering cyber cafe and impounding the books of accounts is in order. It is allowed. The officer can do so. He is allowed to do so. I hope it is clear to all of you. Okay. Now the next question. Which of the following statements are correct? Now we need to read all the statements and then we need to decide which is correct, which is incorrect. Which of the following statements are correct in relation to power of an income tax authority to collect information? Collect information is collected under section 133B, which may be useful for the purpose of Income Tax Act. The first, the income tax authority can enter the place of business only after. No. This is not correct. This point is relevant for survey, not for collection information. This point is not relevant for collection of information. This point is relevant for survey cases. The income tax authority may enter the place of business only during the hours of business, hours at which the such place is open for conduct of business. Yes, this is correct for collection of information under section 133B. See, surveys conducted under 133A and information is collected under 133B. We are talking about 133B, not 133A. So, sunrise, sunset, all those points are given in survey, not for collection of information. Third, the income tax authority may impound and retain in his books of accounts, blah, 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 blah. No, no, no. When you come to collect information, you have to collect information. You cannot collect books of accounts. In 133B, income tax authority does not have the power to collect books. They have the power to collect only information. They can collect information and go away. Okay. And last one. Therefore, this is not a correct statement. Yes, if they want to collect books of account, they have to conduct survey. In survey, they can collect the books. But in collection of information 133B, they cannot take away the books. They cannot take the books into custody. Next one. Last one is a continuation of what I am saying. They cannot remove your books of accounts. Okay. So therefore, this is the correct answer. Therefore, the correct answer is 2 and 4. And therefore, the answer to this question is point number 4. Okay. I hope it is clear to all of you. Okay. Next one. Simple MCQ assessment procedure. Question number 1. Which of the following cannot be adjusted in computation of total income while processing the return under 143(1)? So, what cannot be adjusted? Can an arithmetical error be adjusted? Yes, it can be. Can an incorrect claim apparent from information in the return be adjusted? Yes, it is very clearly written. Can a mismatch of tax audit report and income tax return be adjusted? Yes, it can be adjusted. So, the first 3 points can be adjusted. Definitely, the answer will be the fourth one. The fourth point cannot be adjusted. It is as simple as that. Because the first 3 points can be adjusted, the answer is obvious that the fourth point cannot be adjusted. It is as simple as that. Okay, I hope it is clear to all of you. Now, the next question. Which of the following is not mandated to file the income tax return under section 139(1)? Now, XYZ Private Limited has incurred a loss of 1,50,000. A company will always file return, irrespective of profit or loss. Okay, so the company has to file the return. Mr. Manohar, aged 66 years, having a total income of 3,50,000 before giving deduction under ATC. So, Mr. Manohar, what is the basic exemption limit for Mr. Manohar? It is 3 lakh rupees. Because he is senior citizen, for him it is 3 lakh rupees. Therefore, he will file the return because his income before giving the chapter 6A deduction is greater than basic exemption limit. Therefore, Manohar will file the return. Third one. Mr. Jay, who traveled to Dubai and spent 4.5 lakh. Yes, any person who goes for a foreign travel and incurs more than 2 lakh rupees for himself or any other person is liable to file the return. Mr. Jay is also liable. Fourth one. Miss Mona, a non-resident, having an asset of 2 crore in India and 5 crore outside India, and she is not earned or received any income in India, Miss Mona is not liable to file return. There is no provision in income tax law as of now which says that if a non-resident has assets in India, they have to file ITR. There is no provision like that. Yes, if a resident, an ordinary resident, has asset outside India, they have to file a return in India. If a resident, an ordinary resident, has assets outside India, they have to file a return in India. But the converse is not true. If a non-resident has an asset in India, they have to file a return. There is nothing like that. He is not supposed to file the income tax return. I hope it is clear to all of you. Okay. Let's move on to the next question. That is medium MCQ of assessment procedure. Question number 1. Mr. Ram was born on 1/4/1964. If he was born on 1/4/1964, then he was having his 60th birthday on 1/4/2024. But remember, I have told you there is one CBDT circular. If his 60th birthday is on 1/4/2024, it means he has achieved 60 years on 31st March 2024 itself. One day prior to that, he has achieved 31st March 2024. He has achieved 60 years. Therefore, for previous year 23-24 itself, he is what? He is a senior citizen. And accordingly, you have to answer. Now, Mr. Ram, who is a senior citizen in 2023-24, okay, has a gross total income of 2,90,000. Is he liable to file return because of this? No, because his income is lower than the basic exemption limit. The basic exemption limit for this person, because he is a senior citizen, he is a resident, it is 3 lakh rupees. For him, the total income is below basic exemption limit. No need to file return as of now. He does not claim any deduction under chapter 6A. Now he pays an electricity bill of 10,000 rupees per month. Because of this reason, is he supposed to file the return? The answer is yes. If he is paying electricity charges of 10,000 per month, it means 1,20,000 rupees in the entire financial year. Therefore, if any person pays more than 1 lakh rupees electricity fee in the entire year, electricity charges of more than 1 lakh in the entire year, is liable to file ITR. Third one, he is visiting Melbourne with his wife and the charges are 1.2 lakhs and 80,000 and the total amounts to exact 2 lakhs. So because of this reason also, he is not supposed to file the return, because if you go for a foreign travel for yourself or any other person, then the payment should exceed 2 lakh rupees. Exact 2 lakhs, you are not liable to file return. So he is liable to file return only because of his electricity bill, and therefore the answer to this question is point number 3. I hope it is clear to all of you. Okay, I hope it is clear. The next question is a beautiful question. Pay attention please, all of you. Mr. Mayank, aged 50 years, sold his house for 30 lakhs. Okay, during the previous year to 2021, whereas stamp duty value was 38 lakhs. Now he computed a capital gains of 5 lakhs by wrongly taking the full value of consideration as 8 lakhs. So as the full value of consideration as 30 lakhs. He is selling the house for how much? 30 lakhs. What is the stamp duty value? 38 lakhs. What should he take as a sale consideration? He should take the FVC as 38 lakhs, but he wrongly took 30 lakhs. So he is understating the income by 8 lakh rupees. Okay. Yes or no? He is understating the income now by 8 lakh rupees. He paid the tax accordingly by filing his return under 139(1). Now during previous year 23-24, he wants to correct the full value of consideration by filing an updated return for AY 21-22. So for AY 21-22, you can file an updated return till 31st March 2024. But if you file within 1 year, then you have to pay 20%, 25% additional tax. And if you file after 1 year, but before 2 years, then you have to pay 50% additional tax. Now, what mistake he is doing? He is understating the income by 8 lakh rupees. So on 8 lakh rupees, long-term capital gains will come to how much? The long-term capital gains will come to, assume that it is a capital gains, long-term capital gains of 20% will be tax he has to pay. On that 20% tax, he has to pay 4% cess. Therefore, his tax will come to 166,400. Obviously, he has to pay this 166,400. Apart from that, because he is filing the return in the last year, that is after 1 year from the end of relevant AY. He is filing the return in the last year, that is after 1 year from the end of relevant AY. Therefore, he also has to pay additional tax of 50%, which will come to 83,200 rupees. Is it clear, all of you? I hope it is clear to all of you. Okay. So this is what this question is all about. Beautiful question. Next one. A survey is conducted under 133A in the premise of Mr. Arav, and search is conducted under 132 in the premise of his friend Mr. Arjun on 1st May 2023. So in case of Arav, there is a survey conducted. In case of Arjun, there is a search conducted. The AO issued notice under 148 for AY 21-22, 22-23, 23-24 to Mr. Arav and Mr. Arjun. However, such notices were not accompanied by the copy of order under 148A. So the AO issued the notice, but the order under 148A was not issued. So is the notice valid? So remember, in case of search, there is no need to give any order under 148A. It is deemed to be given. So in case of search, it is valid. But in case of survey, you need to give an order under 148A. Inquiry under 148A is mandatory in case of search case. Therefore, the notice is valid. In case of search, there is no need to give separate order under 148A. Therefore, this notice is valid in case of search, but it is not valid in case of survey. Therefore, you can check over here. In case of, yes, the action of the AO in issuing notice under 148 is valid for Arjun. For Arjun, it is valid. Why? Because in case of Arjun, what is happening? In case of Arjun, search is happening. So in case of Arjun, it is valid. Okay. But in case of Arav, it is not valid, because in case of survey, it is mandatory to conduct what? Inquiry under 148A. I hope it is clear to all of you. Okay. Now, coming to the next chapter now, simple MCQs of appeals and revision. Now, let's talk about appeals and revision. Mr. Rajesh is aggrieved by an order. By which order? An order which is passed by Commissioner of Income Tax imposing penalty under 270A. So, if an order is passed by Commissioner of Income Tax, so where you will appeal? You will appeal to ITAT under 253 within 60 days from the date of communication of the order. So, if an order is passed by CIT, obviously you will go to ITAT under section 253 within 60 days and you have to go within 60 days from the date of communication of the order to you. That is, whenever you receive the order, you have to file an appeal within 60 days. Okay. Now, which of the following order is not appealable before Commissioner of Income Tax appeal? So, for that we need to read all the four orders. An order of penalty under 271B. Yes, this is passed by AO, so you can file to Commissioner of Appeal. This is passed by AO. An order made under 163 to treating the assessee as an agent of non-resident. This is also passed by AO. This is passed by AO, so you can go to Commission Appeal. This is also passed by AO, you can go to Commission Appeal. Third one is a dispute resolution panel order. Remember, an order which is passed by a dispute resolution panel will directly go to ITAT. Do you remember that? If an order which is passed by, which happens in case of what? Non-resident foreign company and transfer pricing assessees. So in those cases, a DRP comes into picture, and if a DRP comes into picture, the matter will directly go to what? The matter will directly go to ITAT. Okay. I hope it is clear to all of you. Right. So this one will not be appealable to CIT appeal, and therefore our answer to this question is answer number 3, because this will directly go to what? ITAT. So why it directly goes to ITAT? I have told you in the class also, because this order is passed by 3 commissioners. DRP is a panel. It's a collegium of 3 commissioners. The 3 commissioners will sit together and will decide your case. Therefore, in this case, the matter will be appealable to what? Directly to ITAT, and it will not go to CIT appeal. The next page is appeals and revision, medium MCQs. Let us read the medium MCQs of appeals and revision. Which of the following order can be revised by principal commissioner under 263 where such order is erroneous and prejudicial to the interest of revenue? First one, an order passed by AO enhancing or modifying the assessment. Can the AO enhance the order? Can a CIT enhance the order or modify the order, which is, and direct the AO to pass a fresh assessment order? Yes, CIT can do that under 263. Secondly, can the CIT modify an order passed by TPO under 92 CA? Yes, CIT can modify the order passed by TPO under 92 CA also, and the question is, what is the time limit? So CIT can modify the assessment and direct fresh assessment for AO's order, and also CIT can modify the order of TPO also. Both the orders are possible. Okay. One last thing, what is the time limit for revision under 263? The time limit is 2 years from the end of the financial year in which the order sought to be revised was passed. So therefore, the answer to this question is, first order can also be revised, which is AO's order for fresh assessment. Second order can also be revised, which is TPO's order for enhancing. And the third thing is, it will be revised within 2 years from the end of the financial year in which such order was passed. I hope it is clear to all of you. Okay. Now coming to the next question. Question number 2. Mr. X is aggrieved by the order passed under 143 subsection 3. Okay. So if you are aggrieved by the order passed under 143 subsection 3, where you will appeal? You will appeal to CIT appeal or JC appeal within 30 days. Okay. And Mr. Y is aggrieved by the order passed under 272A by Director General. So if a Director General is passing an order which is above Commissioner also, then you cannot go to Commissioner appeal. Then you have to go to ITAT within 60 days. Okay. So for Mr. X, you have to go to what? Commissioner appeal within 30 days. Now even JC appeal is applicable. So the institute should change this particular thing within 30 days from the date of receipt of the notice of demand. Whenever we receive the notice of demand, within 30 days, we will go for that. What? We'll go for appeal. And in case of Director General order, we'll go to ITAT within 60 days from the date on which we receive the order. Okay. So whenever we receive the order of Director General within 60 days, we can go to what? We can go for an appeal. I hope it is clear to all of you. Next one, answer to question number 3. The assessment of Epsilon Associates assessment year 23-24 was made on 28th of December 2024, and the AO added 3 lakh rupees, being 30% of 10 lakh for non-deduction of TDS, and AO added one more item, 4 lakh rupees for unexplained investment. So AO is adding 2 things. One is 3 lakh rupees for non-deduction of TDS, and second is 4 lakh rupees unexplained investment. Now, the assessee has filed an appeal against unexplained investment before the CIT appeal. The appeal was also decided in June. What is the remedy available for the other disallowance? Now, for other disallowances, can I go for other options? Now, what is the remedy available for other disallowance? So, see, AO is making 2 disallowances, out of which you are appealing one, and you want to go for the you have appealed one. The case is also decided on the one matter. Now we want to go for the other one. What is the option for the other one? The only option for the other one is apparent mistake. If it is there is an apparent mistake in the other one, you can go for what? 154, because in 154 there is a doctrine of partial merger. Partial merger means the matter which is already concluded, that matter will not be touched, but other matter can be opened. You can go for other matter. Is 263 possible? 263 is not possible. Sorry. Is 264 possible? 264 is not possible. Why 264 is not possible? Because in 264 there is a concept of doctrine of complete merger. Doctrine of complete merger means a complete order of the AO will get merged with the appellate authority, and once it is merged, you cannot touch any other matter. In complete merger, even if one matter has gone in appeal, all the matters will not be allowed to go in revision. Even if one matter has gone in appeal or one matter has gone for revision, none of the matters can go for what? One of the matters can go for what? Revision under 264. But yes, as per section 154, you can go for what? You can go for rectification. Okay, you can go for rectification for other matters, because here the concept of doctrine of partial merger is applicable. I hope it is clear to all of you. Now let's move on to the next point. Next point is dispute resolution panel. Directly the MCQ is of difficult nature. Let's see which dispute. Sorry, it's not dispute resolution panel. It's a dispute resolution committee. What is a dispute resolution committee? It is a committee made by the government of India to address your issues with respect to penalty and prosecution. This is the committee which will give you immunity from penalty and prosecution in some cases. So first question is, which of the following is not a specified order? Which is not a specified order? First of all, assessment order based on search. Yes, it is not a specified order, because the law says that if there is a search against you, if there is a survey against you, if there is a requisition against you, or if there is a information received under DTAA by the assessing officer from the foreign authority, then you cannot go for what? You cannot go for dispute resolution committee. So therefore the first one is, there is a search, therefore you cannot go for dispute resolution committee. If there is a survey, you cannot go for dispute resolution committee. If there is an information received under DTAA, then also you cannot go for dispute resolution committee. In short, you cannot go for dispute resolution committee in all the three cases. In all the three cases, it is not allowed to go for what? Dispute resolution committee. Next one, who amongst the following has not satisfied the specified condition? See, if you are covered under Prohibition of Benami Act, you cannot come under dispute resolution committee. If you are convicted under Income Tax Act, you cannot come under dispute resolution committee. If you are coming under black money law, you cannot come under dispute resolution. These are all the points which are mentioned in section 245 MA. You can go and check. But if there is a penalty which is imposed on you under income tax law, yes, you can go for dispute resolution committee even with the imposition of penalty. If there is a penalty which is imposed on you, you can go for imposition, you can go for dispute resolution committee. But if there is already a law punishable, if you are already punishable under Benami Transaction Act or Income Tax Act, any offense you are punishable, or you are punishable under black money law, then you are not liable to go for what? Dispute resolution committee. Therefore, the answer to this question is what? A, Mr. X, Mr. Y and Mr. Z. Mr. X cannot go, Mr. Y cannot go, Mr. Z cannot go, but Mr. A can go for, he is fulfilling all the specified conditions. I hope it is clear to all of you. Is it clear? So now let's move on to the next one, that is simple MCQ of chapter number 18, that is miscellaneous provision, question number 1. Now, what does this question talks about? This question talks about a company is there, ABC Limited. It is issuing some shares to the shareholder and receiving some money. So, it is issuing shares to a lot of shareholders and receiving the money from them in the form of share application money. So, which all transactions should be reported in SFT? So, remember, only those transactions will be reported in SFT where the amount raised from the shareholder is more than 10 lakh rupees. So, if the amount raised is more than 10 lakh rupees, then it is reported in SFT. Otherwise, it is not reported in SFT. So, with that logic, only this 10 lakh rupees which is raised from Mr. Y and 12 lakh rupees which is raised from Mr. Z, 10 lakh or more it is, actually 10 lakh or more, it is not more than 10 lakhs. So, if you raise 10 lakh or more from the investor, you have to report in the SFT the transaction of that particular investor. Okay. So, from Mr. Y, you are raising 10 lakh, you have to report that, and from Mr. Z, you are raising how much? 12 lakhs. You have to report that also under the income tax law. Okay, I hope it is clear to all of you. So now let's move on to the next question. Question number 2. Can AO accept bank guarantee in exchange of, in lieu of a provisional attachment of property by an order in writing? Now, what is the meaning of this question? The meaning of this question is, for example, the AO has attached your property of 10 crore rupees, okay, under section 281B. So 10 crore property is attached by the assessing officer of yours. Now, can you tell the officer that I will give you a bank guarantee and in exchange, you just remove this particular provisional attachment against my property? The answer is yes. What is the condition? Yes, he can do so where the assessee furnishes a bank guarantee from a scheduled bank first of all, and which is not less than the fair market value of the property attached. It has to be at least equal to the fair market value of the property attached, or for an amount which is sufficient to protect the interest of the revenue. So yes, the AO can revoke your provisional attachment in exchange of what? A bank guarantee which you have to give from a scheduled bank, which should be at least equivalent to how much? At least equivalent to the value of the property, FMV of the property, not less than that. Okay, I hope it is clear to all of you. Next one. Can the AO impose penalty of 50 lakh rupees under 271 AAD on Mr. Rajesh? Okay. So AO is imposing a penalty under 271 AAD for fake invoice. Can he provisionally attach a property? No, he cannot do so. Why? If he wants to attach provisionally your property, in case of penalty under 271 AAD, the penalty imposed has to be greater than 2 crore rupees. Because it is written in section 281B that if you want to impose a penalty, if you want to impose provisional attachment, if you want to impose a provisional attachment in case of a penalty proceeding under 271 AAD, first of all, provisional attachment can be done only for assessment proceeding, not for penalty proceeding. There is only one penalty proceeding for which provisional attachment is possible, and that is this one, 271 AAD. But there is a monetary condition over there. The amount of penalty has to be greater than 2 crore rupees. Only then a provisional attachment can be done in case of penalty proceeding. Here it is only 50 lakhs. Therefore, it is not possible. I hope it is clear to all of you. Okay. Now, the next question is a beautiful question. Medium MCQ miscellaneous provision. In fact, they should remove this from medium and put it in a difficult part. It's a very, very good question. There has been 6 transactions which are given to you. You have to answer which of them will be reported in SFT. Okay. The first transaction, you are making a cash payment of 6 lakh rupees for purchase of bank draft. Whether this will be reported in SFT? The answer is no. For if you purchase a bank draft in cash, then the limit is more than 10 lakh rupees. It has to be 10 lakh rupees. Okay. So therefore, in this case, it will not be reported in SFT because it is less than 10 lakhs. Second, if you are depositing 26 lakh rupees in current account, whether it will be reported in SFT, it will not be reported in SFT. For deposit in current account, the limit is higher than 26 lakhs. It is not 26 lakhs. Okay. So this will also not be reported in SFT. Third, if you deposit 12 lakh rupees in saving bank account, will that be reported in SFT? Yes. If you deposit more than or equal to 10 lakh rupees in saving bank account, then it is liable for SFT report. Okay. Because it is 12 lakh rupees. So if you deposit more than 10 lakh rupees in saving bank account, it is to be reported in the SFT. So this transaction will be reported in SFT. Fourth one, you are withdrawing 55 lakh rupees by bearer check from the current account. So if you withdraw more than 55 lakh rupees from a current account, then it is reported in SFT. So here you are withdrawing more than 50 lakh rupees through a current account, it will be reported in SFT. Okay. Next, if in the entire year, if you make a credit card payment of more than 10 lakh rupees, if in the entire year, if you make a credit card payment of more than 10 lakh rupees by any mode, online or cash, it doesn't matter. If aggregate payment in the entire year is more than 12 lakhs, if more than 12 lakhs, then it will be reported under SFT. And last, so this will be also reported in SFT. And last, if you make a credit card payment of cash less than 1 lakh, no requirement to report in SFT. If you make a credit card payment of more than 1 lakh rupees in cash, so it has to be reported in SFT. So this last one will not be reported in SFT because it is less than 1 lakh rupees. I hope it is clear to all of you. Therefore, the points which will be reported over here is point number 3 will be reported because of the saving bank account. Point number 4 will be reported because you are withdrawing more than 50 lakhs from current account. And point number 5 will be reported because you are paying a credit card of more than 10 lakh rupees in the entire financial year. I hope it is clear to all of you. So now let's move on to the next question. This is a beautiful question. It's a difficult question of miscellaneous provision which is on 269SS and 269T. Now you have to be very careful with this because there are a lot of games played by the ICAI over here with respect to dates. Okay. So you have to be very careful with the dates. ABC Private Limited engaged in trading of goods availed the following interest-free loan from XYZ Private Limited. Okay. So first loan is availed on 8 lakh rupees loan by ECS through bank account on 10th April. Therefore, no 269SS will not apply. Why? Because the loan is availed by check, online payment, ECS, such other electronic mode. It is allowed. Account pay check, account pay draft, ECS, such other electronic mode allowed. Second loan. Second loan is on 18th of August 2023. Now listen carefully. You have to be very careful with this. First of all, you took a loan on 10th of April. Okay. And then you took a loan on 10th of April. And then on 15th of July, you have repaid the loan of 6 lakhs. Okay. Then on 50,000 on 3rd of July. And then 1,50,000 on 3rd of August. Okay. And then after that you are taking this loan. You have to be very careful. You are taking this loan of 18,000 by cash after all these things. So on 18th of August, what was your outstanding balance? Outstanding balance in the name of other party, it is 0 rupees. There is 0 outstanding. Therefore, if there is no outstanding, you can receive less than 20,000 rupees in cash. So again, 269 SS will not apply. I hope it is clear to all of you. Okay. Now, what is the status on 19th of September 2023? On 19th of September 2023, what is the status? Pay attention, please, all of you. Okay. Be very careful. On 19th of August 2023. So on 18th August, on 19th September 2023, on 18th August, you took a loan. Okay. Then on 1st September, you have already repaid 15,000 out of this loan. See, out of this 18,000, you already paid 15,000 on this. But okay. So on 19th September, the outstanding is only 3,000 rupees. Okay. So on the date of taking the cash loan, the outstanding is only 3,000 and aggregate of 2 is also not exceeding 20,000 rupees. Therefore, again 269 SS will not apply. So here also 269 SS will not apply to you. Okay. Now coming to 269T. 269T. The first repayment you are doing. So I am again saying on the first transaction, you are not going to pay any penalty. Why? Because you are receiving the money by ECS. On the second transaction, when you are taking 18,000, on the date of that taking that 18,000 in cash, on that outstanding loan is 0 rupees because you have already repaid in the form of 3 repayments. And on the date of taking this 12,000 cash, the outstanding is only 3,000. Therefore, the aggregate of 2 is also not 20,000. Therefore, penalty will not be imposed. Now, while repaying, in the first case, 6 lakh rupees you are repaying. So, no penalty can be imposed on that case. In the second case, you are paying 50,000 rupees. And what is the outstanding on that date? On the outstanding on the date of making the payment of 50,000, how much is the outstanding? On 3rd July, the outstanding is around 2 lakh rupees. So 2 lakh is outstanding and you are paying 50,000 in cash. Therefore, 269T will apply now. I hope it is clear to all of you because on the date of repayment of 50,000 in cash, there is already an outstanding of 2 lakh rupees in the books of accounts. And if on the date of making the cash payment, if there is an outstanding of 20,000 or more, you cannot make a cash pay repayment of even a single penny. Even a single penny cannot be repaid. Therefore, now you will be liable for a penalty. Then 1,50,000 you are paying by ECS, so no penalty can be imposed. And then on 1st September, again your payment is only 15,000. And on 1st October also it is only 15,000. So again no penalty will be imposed. So penalty will be imposed only in one case, that is 50,000 rupees paid cash on 3rd of July 2023. So the entire game over here is of dates. ICAI is playing with the dates over here. So you have to be very careful with the dates over here. Okay. I hope it is clear to all of you. Now let's move on to the next chapter, which is penalty, and it also covers black money law. Also covers the chapter of black money law over. Okay. So first, few questions are based on some penalty computation over here. Mr. Dinesh is a resident individual whose age is 47 years and he has not furnished the return. Now, if he has not furnished the return and if his income is assessed as per best judgment assessment under 144, how much penalty will be imposed on him? See, first of all, to compute penalty, we need to compute the underreported income, then tax on underreported income, then penalty will be computed. Now, by default, what you will follow from this year onwards for individual HUF? You will follow the new regime. So, you will follow the new regime for computing tax. Now, how to compute underreported income in such cases? It is income assessed, it is 18 lakhs, minus the basic exemption limit, which is 3 lakhs under new regime. So 18 lakhs minus 3 lakhs will come to 15 lakh rupees. So 15 lakh rupees is your what? Is your underreported income. Now how to compute tax on underreported income? It is tax on underreported income plus basic exemption limit. So whatever is your underreported income plus basic exemption limit, in short you have to compute tax on 18 lakh rupees. Tax on 18 lakhs as per new regime comes to 249,600. You can compute it, okay? And then on that, by default it is a normal case, so 50% penalty will be imposed. So 50% of this will come to 124,800. I hope it is clear to all of you. So there are a lot of things that you have to keep it in mind. If nothing is mentioned, you have to follow new regime. If nothing is mentioned, you have to consider 50% only. Don't unnecessarily take 200% of the penalty if nothing is mentioned in the question, okay? So be very careful. Next question, Mr. Mahesh is found to be the gold chain of 50 grams each, okay, which was not recorded in the books of accounts as he could not satisfactorily explain the amount. So if you are found with gold chain of 50 grams each and the AO is asking you the source of that, you're not explaining the source of that, that is unexplained asset, okay, unexplained asset. And for unexplained asset, how much is the gold chain? 50 gram each, value of that is 1,45,000. Therefore, the total value will be 2,98,000. And for unexplained asset, unexplained money, bullion, jewelry, unexplained expenditure, there is a tax under 115 BBE, which is directly taxed at 78% tax. Therefore, the answer will come to 226,200. But according to me, this answer is wrong. The ICAI has given a wrong answer. Why? Because there is a CBDT circular which says that a male member can keep up to 100 grams gold without explaining the source. Every male member in this country can keep 100 gram gold without explaining the source. Therefore, with that logic, the assessee should not have been taxed. But unfortunately, Institute has taxed in this particular question. Okay, I hope it is clear to all of you. Now, let us come to the medium provisions of this particular chapter, that is penalty. There are two people, Mr. Ganesh and Mr. Rajesh. Both of them are resident. Ganesh was born on 1st July 1963. Therefore, Ganesh age is 60 years in the current year. And Rajesh was born on 1/4/1944. Therefore, Rajesh is super senior citizen. The basic exemption limit will be 5 lakh rupees. Okay. Now, they have not furnished the return and they have been assessed under 144 at 8 lakhs and 5 lakhs. Is the penalty leviable under? If yes, what is the quantum? Now, Ganesh is 60 years and Rajesh is what? Rajesh is 80 years. Okay. Now, for Ganesh, what we will do? We will follow the new regime. Why? Because under the new regime, the tax is going to come lower. And because the tax is going to come lower, the penalty will also come lower. Okay. But for Rajesh, we will follow old regime. Okay. Why old regime? Because for Rajesh, if the income is up to 5 lakhs, under old regime, up to 5 lakh income, there is no income tax. If I follow new regime for Rajesh now, then for Rajesh also above 3 lakh, Rajesh has to pay tax. Yes or no? Therefore, for Rajesh, what I am doing? I am following the old regime. I hope it is clear to all of you. Therefore, for Rajesh, no penalty will be imposed under the income tax law. Okay. And for Ganesh, the penalty will be imposed up to what? Up to 50% of 36,400 rupees, which is 18,200 rupees. Okay. I hope it is clear to all of you why I am doing so. First of all, both of them have not filed the return and therefore both of them are liable for what? Best judgment assessment. And one is senior citizen, one is very senior citizen. So for one, I am following what? I am following new regime because that is more beneficial. For other, I am following old regime because that is more beneficial under the income tax law. Now, let's talk about the next question, which is based on black money law. The next question is asked based on, next two questions are based on black money law. Mr. Arvind opened a bank account in country P on 1/7/2020. Okay. Now, he made the deposits of foreign currency equivalent to 5 lakh. So first he deposited 5 lakh rupees on 1st July 2020. Okay. Then on 1st October 2020, he deposited another 7 lakh. Then on 1st September 2022, he deposited another 12 lakhs. And then on 1st March 2024, he deposited another 25 lakhs. Okay. Out of an Indian income which has not been assessed to tax in India. So he deposited the money in foreign bank account without paying taxes in India. So that is an undisclosed income which has been deposited in the foreign bank account. Now, this deposit of 12 lakh na is out of the earlier withdrawal. So this 12 lakh rupees is out of the earlier withdrawal. With this 12 lakh rupees is a withdrawal of these two items and then he has again deposited back. So the law says what? Whatever money is deposited back from the earlier withdrawal, that should not be taken for the purpose of calculating the value of asset. Okay. What is the value of asset in case of bank account? It is the entire amount deposited from the date of opening till the date on which the assessing officer found it. So from the date of opening till the date on which assessing officer found it, this is the total deposit which is made. But if some deposit is made by withdrawing from the earlier deposit, so 12 lakh is made by withdrawing from the earlier deposit, so that much should be ignored. Therefore, only how much should be considered? Only this 5 lakh should be considered, this 7 lakh should be considered, this 12 lakh should be ignored, and this 25 lakh should be considered. And therefore, the answer to this question is what? It is 37 lakh rupees. I hope it is clear to all of you. The next question is a similar question which we have done in class also. I hope it is clear to all of you. Let me read the question first of all, then you will understand. Mr. Arvind acquired a flat in country P in 1819 for how much? For 50 lakh rupees. Okay. So in 2018-19 he purchased a flat. Now out of the said sum, 20 lakh was assessed to tax in the total income of 18-19 and earlier years. So he has bought a flat of 50 lakhs, but out of that 50 lakhs, he has already paid tax on 20 lakh rupees. Suppose I bought a flat of 50 lakh. Now the officer is asking me from where you have got the money. So I'm not able to explain the source of 30 lakhs. But 20 lakh rupees I am able to explain the source, and I am able to pay. I have already paid tax on 20 lakh rupees. Okay. Now this comes to the notice of the AO. If the value of the flat on 1/4/2023 is 90 lakhs, how much amount will be chargeable? So the law says that whatever is the value of the flat, that will be allowed, that will be chargeable. We will get some reduction out of it. How much reduction? Whatever is the value of flat today multiplied by whatever is the amount which you have paid as tax earlier on 20 lakhs divided by whatever is the cost of that asset. Okay. So how much reduction will be allowed to you? Whatever is the value of flat today multiplied by, this is only available for immovable property. This is not available for other assets. Multiplied by whatever you have already paid tax earlier, that is 20 lakhs, divided by whatever is the cost of the asset, that much will be allowed as a reduction. So out of 90 lakhs, 36 lakhs will be allowed as a reduction, and therefore only 54 lakhs will be taxable in your hands. Okay. I hope it is clear to all of you. And this relaxation is only for immovable property in black money law. It is not there for other assets under the black money law. Okay. I hope it is clear to all of you. Now next one. Mr. X is a foreign national. Mr. X is a foreign national. He is a citizen of other country, United States. Okay. He is a citizen of United States. Now he is working with a foreign company, MINC, US based company. Now he came to India during the previous year 23-24 for rendering services on behalf of the employer. Now he wishes to claim his salary income earned during his stay as exempt. Which of the following is not a condition to be fulfilled to claim such remuneration as exempt under the income tax? Now listen carefully all of you. Suppose if there is a foreign citizen who is working in a foreign company, who is coming to India for some work, he is rendering services in India, then his remuneration is exempt, subject to three conditions. First, that foreign company should not have any trade and business in India. So this condition is correct. The foreign company should not have any trade and business in India. MINC should not have any trade and business. Second, that employee should not stay in India for more than 90 days. Okay. And third, that foreign company should not claim that remuneration as a deduction in India. Therefore, the first condition is a valid condition to claim exemption. Third condition is a valid condition to claim exemption, and the fourth condition is also a valid condition to claim exemption. Mr. X should not do any trade or business in India. This is not a condition. There is no condition which says that the employee should not do any business or profession in India. There is no condition which says that the employee who is coming to India should not do any what? Any business or profession in India. So check it please. Is it clear? Let's move on to the next question. Okay. Next question. Mr. Ranveer, a non-resident, has earned interest income of 6,20,000 during the previous year 23-24 on bonds issued by Tilt Limited, an Indian company, under a scheme notified by central government, which are purchased by him in foreign currency. So a non-resident is purchasing the bonds of Indian company, which is notified by central government, and it is also purchased in foreign currency. Therefore, this section is section 115 AC. Whatever interest income is there, that will be subject to 10% tax and 4% cess. Surcharge is not applicable because the income is only 6,20,000 rupees. If the income would have been more than 50 lakh rupees, I would have imposed surcharge also. So here the tax rate will be only 10.4%. 115 AC covers the bonds of Indian company which is notified by central government. I hope it is clear to all of you. Next one, question number 3. Mr. Ganesh, a citizen of India, is employed in an Indian embassy in USA. So, Mr. Ganesh is an Indian citizen. He is working in an Indian embassy in USA. So, remember, if an Indian citizen is working in an embassy in USA, then his salary is taxable, but his allowances and perquisites are exempt. Remember that or not? His salary, whatever salary the government of India pays, that is deemed to accrue or rise in India. Whatever salary the government of India pays, that is deemed to accrue or rise in India. But whatever allowances and perquisites the government of India pay, that is exempt under section 10 clause 7. Therefore, with that logic, the salary is taxable in the income tax law in India, but the allowances and perquisites are what? Are exempt under the income tax law. I hope it is clear to all of you. Okay, let's move on to the next question. The next question is a beautiful question. It's based on an amendment made by Finance Act 2023. M Limited and N Limited are Indian companies which have to pay interest of 2 lakh rupees and 1 lakh rupees outside India to Mr. P, a non-resident during the previous year 23-24 on rupee denominated bond listed on a recognized stock exchange in IFSC, issued in May and issued in August 2023. Now, what would be the tax rate in such case? Remember, if an Indian company is making a payment of interest to a non-resident on bonds and rupee denominated bonds, if it is purchased between 1st April 2020 to 31st before 1st July 2023, if it is purchased between 1st April 2020, if it is purchased between 1st April 2020 before 1st July 2023, then the tax rate is just 4% under 194 LC. And if it is purchased after, on or after 1st July 2023, then the tax rate is 9% as per 194 LC. This is an amendment made by Finance Act 2023. 4% before 1st July 2023 and 9% on or after 1st July 2023. On that you will apply the cess. 4 plus 4 will come to 4.16 and 9 plus 4 will come to 9.36%. So, because the first one is purchased before July, so in that case 4% tax will be charged. And in second case, because it is purchased in August 2023, so 9% tax will be charged, plus cess is always imposed in case of non-residents. Okay. Now, the next one is a simple question, nothing great as such. There is nothing to say as difficult in this question. This is based on non-resident shipping business, okay, which is covered under 44B. A ship cargo, a company based in Netherlands operating its ships to and fro Cochin port collected freight of 85 lakhs, demurrage charge of 5 lakhs and handling charge of 2 lakhs in respect of goods shipped at Cochin port. So whatever goods are shipped from Cochin, if the goods are shipped from India, then that is deemed to accrue or rise in India. Then that is subject to tax in India. This will also include demurrage charge and handling charge. So this is your normal freight charges, then demurrage charge, handling charge, all these things will be included in India. Apart from this, the ship has also shipped from Netherlands, but the amount was received in India. So if the ship is shipped from Netherlands, if the goods are shipped from Netherlands, but the amount is received in India, then also taxable in India. So all of them are taxable in India without deduction of any expenses under PGBP. No deduction of PGBP expense will be allowed, and this will be subject to 7.5% deemed income. Okay, so 85 lakhs why taxable? Because goods are shipped from India. Demurrage charge and handling charge are also part of revenue. Okay, and 50 lakhs is chargeable because the money is received in India. The goods are shipped outside India, but the money is received in India, therefore it is taxable in India. And all of them will be subject to 7.5% deemed income, and that is your deemed income. The deduction of expenses are not allowed under 44B. I hope it is clear to all of you. Okay, let's move on to the next question. That is the medium MCQ of double taxation relief, which is on DTAA. There is an assessee, Mr. Samrat, a resident Indian. He has earned an income of US dollar equivalent to how much? 4 lakh by way of lump sum consideration for copyright of book. So he has wrote some book on which he has earned a copyright of 4 lakh rupees. Okay, being a work of literary from a publisher in country E, with whom India does not have DTAA. So he is earning that income from such a country with which India does not have a DTAA. Okay, now the tax rate in that country is 5%. Okay, now the amount has been remitted to India. Now his gross total income in India is how much? It is 7 lakh rupees. We need to find out what? We need to find out his total income, and we need to find out how much deduction will be available to him under section 91. Okay, assuming that Samrat exercises the option to shift out of the default tax regime. He does not like to be part of default tax regime. First of all, how much deduction will be allowed as a unilateral relief to him? For that, we need to compute his tax in India first. Okay. Now, royalty from book is 4 lakh rupees. Okay. Now, other income he has earned how much? Other income he would have earned 3 lakh rupees. How I came to know? Because his royalty is 4 lakh and his GTI is 7 lakhs. Therefore, his other income would have been 3 lakh rupees. Now, his GTI is how much? 7 lakh rupees. Now, from 7 lakh rupees, he is going to get a deduction of 3 lakh rupees as what? 80QQB deduction is allowed not to royalty on books. Royalty in books is subject to 80QQB. Therefore, there is a total income of 4 lakh rupees. Now, the tax is how much? Tax is 0 over here. Why? Because the assessee will get a rebate. He is a resident in India up to 5 lakh rupees under old regime. He is not following the new regime. He is shifting out of the default regime. He is following the old regime. So under the old regime also, he will get full rebate of up to 5 lakh rupees, right? And therefore, the tax payable in India is 0 rupees. Because his tax payable in India is 0 rupees, the question of relief under 91 does not arise only. Because to get relief under 91, there has to be double taxation. Nah, there is no double taxation. The taxation is only in the foreign country at 5%. In India, there is no tax only. Therefore, the question of relief under double taxation is not arising over here. Okay. I hope it is clear to all of you. Okay. Now, next question, which is on medium MCQ advanced ruling chapter. As per section 245N, clause A, subclause 4, ruling means what? Advance ruling means determination or decision by the board for advance ruling as to whether an arrangement which is proposed to be undertaken by a person is an impermissible avoidance arrangement or not. For making an application in this regard, the applicant has to be whom? So this is a case of GAR, because impermissible avoidance arrangement comes in the case of GAR. So in case of GAR, who can make an application? Everybody can make an application. Either a resident can make application, even a non-resident can make an application. There is no limit of monetary limit also in case of GAR. In case of GAR cases, everybody can make an application to identify whether my case will fall in GAR or it will not fall in GAR. Okay. I hope it is clear to all of you. Now let's talk about some MCQs based on what? Transfer pricing. Simple MCQs of transfer pricing. First of all, the first MCQ is the Alpha Limited's total income has been increased by 34 lakhs by the assessing officer. Okay. So the assessing officer has increased the arm's length price, and because of that, the income of the assessee has increased by 34 lakhs. Now, once the assessing officer increases the income, do you remember that? After that, on that increased income, you cannot claim any chapter 6A and you cannot claim any 10AA. Remember or not? But can you claim business loss? The answer is yes, you can claim business loss. Can you claim chapter 6A? No, you cannot claim chapter 6A. Can I claim against that increase income unabsorbed depreciation? Yes, you can claim unabsorbed depreciation also. Therefore, the correct answer is 2. The deduction under chapter 6A cannot be claimed. That is correct answer. Business loss cannot be claimed. It's a wrong answer. It can be claimed. Unabsorbed depreciation cannot be claimed. It's a wrong answer. It can be claimed. Only restriction is on chapter 6A and only restriction is on 10AA. Chapter 6A and 10AA cannot be claimed against your enhanced income. Rest of the things can be claimed against your enhanced income. I hope it is clear to all of you. Okay. Next one. If ABC has 2 units, unit 1 is engaged in power generation business. Therefore, unit 1 is eligible for 80IA business. Be very careful. 80IA business is covered under what? Power generation business is covered under section 80IA profit link deduction, and unit B is engaged in manufacture of wires. Therefore, unit 1 is an eligible unit for profit link deduction and unit 2 is not an eligible unit for profit link deduction. Both the units were set up in Karnataka in the year 2015. In the year 2023-24, 20 lakh meter of wires, 20 lakh meter of wires are transferred from what? Unit 2 to unit 1 at 125 lakh, at 125 per meter when the market price was 180. So how much? 20 lakh into 125. 20 lakh into 125 comes to 25 crore rupees. It is 20 lakhs. It is not 25 lakhs. 20 lakh into 125. Remember, one unit is eligible for 80IA. Another unit is not eligible for 80IA. And it is selling at a different price than market price, then domestic transfer pricing is applicable, provided the aggregate value of transaction in the entire financial year should exceed 20 crore under domestic transfer pricing. Here is it exceeding 20 crore? 20 lakh meter into 125 rupees per meter will come to more than 20 crore definitely. It will come to 25 crore rupees. Therefore, domestic transfer pricing will be applicable in this case. I hope it is clear to all of you. Is it clear? So in this case, the transfer pricing provision would be attracted in this case, and that to which transfer pricing provision will attract? Domestic transfer pricing provision will attract in this case. Okay. Now the third one is a very simple question actually on what? On 94B. Y is a foreign company having a permanent establishment in India, namely X. Okay. So Y has a P in India. Now Z is a non-resident associate enterprise, has invested 900 crore through a debt in X. Okay. Now earnings before interest, that is EBITDA, is 150 crore. What is the EBITDA? EBITDA is 150 crore. And what is the amount of interest allowable in respect of debt, assuming that debt was invested on the first day of the financial year and the rate of interest is 10%. Now you might be knowing that. So again, we need to understand the placing of the people over here. Y is a foreign company having a permanent establishment in India. So Y is in India. Okay. So Y is in India. Z is a non-resident. So Z is a non-resident who is outside India. Okay. Now he has invested 900 crore through debt in X. Okay. He has invested how much? 900 crore through debt in X. So it is going to be covered under what? 94B. 94B will be attracted over here. And under 94B, what is the disallowance which is there under 94B? What is the question? What is the amount of interest allowable in respect of debt? They are asking us how much interest is allowed. But 94B tells us how much interest is disallowed. How much interest is disallowed? Whatever is the interest paid, minus 30% of EBITDA. How much is the interest paid? On 900 crore, 10% interest will come to 90 crore. Minus 30% of EBITDA will come to 30% of 150 crore. Therefore, point number 1 will come to how much? Will come to 45 crore. What is point number 2? Point number 2 is interest paid to associate enterprise. Interest paid to associate enterprise is 90 crore. Therefore, lower of the two will be disallowed. Therefore, out of 90 crore, 45 crore will be disallowed. And therefore, out of 90 crore, 45 crore will be allowed to the assessee. I hope it is clear to all of you. So, out of 90 crore, how much is allowed? How much is allowed? 45 crore is allowed and 45 crore is disallowed to the assessee. Okay. Now, let's come to the medium MCQs of transfer pricing. X Limited has failed to report an international transaction. So, if the assessee has failed to report an international transaction, which all penalties will be imposed? First, a penalty of 2% of the value of transaction will be imposed under 271AA. Under which section? 271AA. And then 200% of tax payable will be imposed under 270A. It is a misreporting of income. Therefore, both the penalties will be imposed on the assessee for not reporting a transaction. If an assessee does not report transactions, both the penalty are imposed on the assessee. I hope it is clear to all of you. Now, let's move on to the next question. Under which of the following methods arm's length price should be the arithmetical mean of the value included in the data set, irrespective of the number of entries? So please tell me, in which of the method you do not follow the range concept? Arithmetic mean is taken for those cases where range is not applicable. So range concept is not applicable in case of profit split method. Apart from this, all the three methods, range concept is applicable. In fact, 4 methods range concept is applicable. Range concept is applicable for cost plus method also, transactional net margin method also, cup method also, and your 4th method, resale price method also. All the 4 methods range concept is applicable. Range concept is not applicable only in case of profit split method. In case of profit split method, you have to take the arithmetic mean irrespective of whether the number of items are less than 6 or it is more than equal to 6. It doesn't matter. Okay. I hope it is clear to all of you. Next one is again a transfer pricing case, a difficult case on transfer pricing. Let me talk about that. First of all, question number 1. A notified infrastructure debt fund. So infrastructure debt fund is there. Eligible for exemption under 1047. Has to pay an interest of 5 lakh rupees to company incorporated in a foreign country. So the company is incorporated where? In a foreign country. Okay. So how much TDS will be applicable? If an infrastructure debt fund pays interest to a foreign company, as per section 194 LB, it is 5% tax. 5% TDS under 194 LB and 4% cess. Therefore, the answer is 5.2%. Okay. Now, there is another foreign company. The foreign company has incurred an expenditure of 12,000 rupees. The expenditure of 12,000 will not be allowed as deduction. That is not allowed under income tax law. Okay. Now, the fund also has to pay interest of 3 lakhs to Mr. Frank, and Mr. Frank is located in NJA. So, if a payment is made to a person located in NJA, then the TDS rate will be what? It will be directly 30% plus cess. Okay. So, in case of Mr. P, the tax will be, TDS will be 31.2%. I hope it is clear to all of you. The first company was located in a normal country. Therefore, as per 194 LB, it was 5% plus cess. The second person is located in NJ. Therefore, the TDS rate would be 30% plus 4%, 31.2%, which is written in section 94A. Now, all the MCQs after this are theoretical MCQs, nothing read as such. Okay. Which action plan developing a multilateral instrument on treaty measures to tackle BEPS? So, it is action plan 15, which talks about making an MLI. MLI is covered in action plan 15. So, nothing great as such is there. Now, all these are very self-explanatory. Fundamentals of base erosion and profit shifting, medium MCQ question number 1. What are the BEPS action plan based on fundamental pillars of transparency? So, which all action plans are based on transparency? Action plan 11 is based on transparency. Action plan 5 is based on transparency. Action plan 13 is based on transparency. And action plan 14 is based on transparency. For that, you have to read the respective chapter and you will come to know how these action plans are talking about transparency. I cannot go and teach about each and every action plan in detail here. That is not practically possible over here. You can watch the revision video or you can watch the respective lecture. Third one, difficult fundamentals of base erosion and profit shifting. Which are the forms of hybrid mismatch arrangement? Okay. So, which are the forms of hybrid mismatch arrangement? So, hybrid mismatch arrangement comes in action plan 2. Okay. And if you see the hybrid mismatch arrangement, all these 4 points are covered in action plan 2. You can go and check the action plan 2. Participation exemption regime, misuse of foreign tax credit, creation of 2 deduction for single borrower, and generation of deduction without corresponding income inclusions. All of them are part of hybrid mismatch arrangement. Okay. Now, next one is while interpreting, next chapter, simple MCQ application and interpretation of tax treaty. While interpreting the treaty entered into by India with the country P, the budget speech of finance minister was relied upon to understand the intent at the time of signing the treaty. Which law of interpretation has to be followed in this case? So, as per which law of interpretation, the budget speech of finance minister is relevant to determine the interpretation of a statute, and it is purposive interpretation. So, as per purposive interpretation, the budget speech of finance minister would be relevant to determine a particular intent of the law. Okay. Now, the next one in the last chapter is latest development in the international taxation. This is a new topic which is added by the institute in the new course. I don't think so. It is very, very important in the examination. Now, the first question over here is in the simple part. Pillar 2 consists of how many things? Pillar 2 consists of 2 things. First is globe rules, that is global anti-base erosion rules, and STTR rules, that is subject to tax rules. So, pillar 2 consists of 2 things, that is globe rules, global anti-base erosion rules, and subject to tax rules. These are the 2 rules which are covered in the pillar 2 concept. Okay. As per the pillar 2 rules, how much tax will be the minimum tax under both the rules? Under the globe rules, the government has said that we will take minimum 15% tax, which is decided by the OECD, and under the STTR, the government has said that, which is again decided by the OECD, that we will take at least 9% tax in the STTR rules. Okay. I hope it is clear to all of you. Amount A is what? Under the globe rules, etc. Amount A is 25% of the residual profit that will be allocated to the market jurisdiction. Now, to understand all these things, you need to read that particular chapter. Otherwise, you will not understand all these things. Okay. So, please go and read that particular chapter. Only then you will understand what I am trying to say over here. In scope companies are MNCs with global turnover of 20 billion euros and profitability about 10%. Okay. In scope companies are, which companies are called as in scope companies? So, in the examination, if they ask you, in scope companies are which companies? So, you have to say a company whose global turnover is greater than $20 billion and profitability is about 10%. Profit means profit before tax upon revenue. If it is greater than 10%, then it can be called as what? In scope revenue, in scope companies. Okay. And one last thing, which rule imposes a top-up tax on parent entity of the constituent entity located in the low tax jurisdiction? So, if there can be a top-up tax on the parent entity as per the rule of income inclusion rule. So if I am a Reliance Industry and if my subsidiary is in low tax jurisdiction, so I have to bear the tax of that subsidiary in the parent country. In India, I have to bear the tax of my subsidiary which is located in what? Low tax jurisdiction, that is known as income inclusion rules. So here we complete all the individual MCQs. So after this we are going to start with what? The case scenario MCQs. I hope it is clear to all of you. So now let's go ahead with the next part, and that is the case scenario MCQs for all of you. Let us talk about the first case scenario. Let me read the first case scenario all of you for you all, and then we'll read all the MCQs one by one. Okay. The first one is Mr. Subhash is a retailer of car spare parts. Okay. He started his business in 2022 May, and his turnover for the last year was 10.5 crores. He generally purchases goods from car accessories and company only. Now this car accessories and company is the seller. Subhash is a buyer. Car accessories and company manufacture and sell spare parts directly to the customers as well as through e-commerce platform. That is carparts.com. Now car accessories and company's turnover for last year was 15 crore. What was Subhash turnover? Subhash turnover was 10.5 crore and car accessories turnover was 15 crore. Now this is how they have purchased. The relevant information of the purchases made by Mr. Subhash in previous year 23-24 is as follows. Date of credit in the books of accounts, date of payment, value of spare parts without GST, and then the total value of spare parts including the GST portion. Okay. Now, in addition to the above, Mr. Subhash also purchased spare parts of car accessories and company for 12 lakhs inclusive of 18% GST through a website known as carparts.com. Okay. On 31st December 2023. Car parts was made, the payment was made directly to car accessories and company on 15th of Jan 2024. PAN is duly furnished by Mr. Subhash, car accessories company and car parts. GST portion is indicated separately in the invoice, but it is not shown separately when the goods are purchased through carparts.com. Based on the above facts, choose the most appropriate answer to question number 1 to question number 5. Okay. Now you need to be very careful. This is a question on 194Q 2061H. Okay. As it appears to be. It is a question definitely on 194Q and 2061H. Where Subhash is a buyer and car accessories and company is a seller and car parts is an e-commerce operator. Okay. Now let's read the first question. Is Mr. Subhash required to deduct tax at source in respect of the purchases made directly with the car accessories and company? If yes, when? And what is the amount of tax to be deducted? Okay, now listen carefully. Mr. Subhash, is he liable to deduct TDS? Listen carefully. TDS is deducted under 194Q if my last year turnover has to be greater than 10 crore. Is it greater than 10 crore? Yes. Subhash last year turnover is 10.5 crore. Now TDS is deducted if the aggregate payment in the financial year exceeds 50 lakh rupees. Okay. So the moment it will exceed 50 lakh rupees, I will start to deduct the TDS. Now TDS is deducted on credit or payment, whichever is earlier. Okay. And in that also, when credit is happening first now, when credit is happening first, then you will deduct TDS on exclusive GST. But when payment is happening first now, when payment is happening first and credit is happening in future, it means we are making payment first and the invoice will be done in future, then the TDS will be deducted on inclusive of GST. You have to be very careful with these points. All these things are mentioned in our color book. You can go and check. So now, when are you making the first payment? First payment is on 15th of May. First credit is on 15th of May and payment is in June. So whether TDS will be applicable in this case? What is first? Credit is first, payment is next. So TDS will be deducted on exclusive GST. And now exclusive GST, it is less than 50 lakhs. Therefore, no TDS as of now. Okay. So in first case, credit is first, payment is later. Therefore, TDS will be deducted. The timing of deduction will be the date of credit. And therefore, because it is deducted on based on credit, you have the breakup of invoice. This much is GST, this much is value of spare parts. Therefore, it is less than 50 lakhs, no TDS. Now on second time, what is first? Credit is first, payment is next. Okay. And now it is exceeding 50 lakh rupees. First 45 and then 15. So total how much? Total 60 lakh. So now on 10 lakh, 0.1% TDS will be deducted on 18th of June. Okay. So on 10 lakh, 0.1% will come to 1000 on 18th of June. Okay. This is how you are supposed to go ahead. The third transaction. Credit is happening later. See, in the third transaction, credit is happening later. Payment is happening first. Credit is on 28th August. Payment is on 17th August. Therefore, now the TDS will be deducted on entire 25,37,000. So on entire 20 lakh 35, 27, 35, 0.1%, 2537 on 17th of August. I hope it is clear how to determine it. So if you make the payment first, then you have to deduct from the entire amount. If you make the credit first, then you have to deduct TDS on the amount exclusive of GST. I hope it is clear to all of you, right? Fourth one, 14th Feb, you are doing the credit and 28th Feb, you are making the payment. So you are doing the credit first. So you will deduct TDS on what? On exclusive GST portion. That is on 10,50,000, 0.1%. That is 1050 on 14th of Feb. I hope it is clear to all of you. So this is the answer to the first question. Okay. Now what is the answer to the second question? Is car accessories and company required to collect tax at source in respect of sale transaction with Subhash? If yes, when and what is the amount of tax to be collected? Now listen carefully. On this first transaction, okay? Listen carefully, okay? So on this first transaction, which is there on this, which I am highlighting now, on this transaction, think from the perspective of the seller. The seller is selling how much goods? The seller is selling you goods of 53,10,000. Is the buyer deducting TDS? Buyer is not deducting TDS. Is the seller last year turnover also greater than 10 crore? The answer is yes. The seller's last year turnover is also greater than 10 crore. And buyer is not deducting TDS. So seller will deduct TDS on, and TCS, seller will collect TCS on excess of 50 lakh rupees. And what is in excess of 50 lakh rupees? It is 3,10,000 rupees. So on 3,10,000 rupees, the seller is liable to collect TCS. How much TCS seller will collect? 0.1% on 3,10,000 rupees, which will come to 310. I am again saying, when the first transaction is happening, and TCS is always collected inclusive of tax, inclusive of GST, always. For TDS, there is a point which we need to think, that what is happening first. If credit is happening first, then exclusive GST. Payment is happening first, then inclusive GST. But in case of TCS, it is not like that. Always inclusive of TCS. Always inclusive of GST. So when the first transaction is happening on 15th of May and the payment is done on 2nd of June. So TCS under 206C1H is applicable first of all on receipt basis, not whichever is earlier. So TCS will be applicable on 2nd June. And TCS will be always collected on the entire amount, including the GST portion. So in excess of 50 lakhs. So in excess of 50 lakhs, it is how much? 3,10,000. Therefore, on 3,10,000, 2nd June. Why 2nd June? Why not 15th May? Because TCS is collected on receipt basis, not on receipt or payment, whichever is earlier. It's not on like that. It's on receipt basis. It's not like receipt or credit, receipt or debit, whichever is earlier. It's not like that. It is on receipt. TDS is on payment or credit, whichever is earlier. But 206C1H TCS is always on receipt basis. So be very careful. Okay. So 206C1H TCS will be applicable over here. Okay. Because on first transaction, TDS was not applicable. Let me come to the third one. Assume that Mr. Subhash has started the retail business in May 23. Okay. Okay. In such a case, would the answer of MCQ1 and MCQ be different? If yes, what would be the answer of MCQ1 and MCQ2? So if Mr. Subhash has started the business in March, in what? In May 2023. Yes, the answer to MCQ1 would change to D and answer to MCQ2 would change to B. Why? I am telling you. Because why? In first case, it will change to D. Why? Because if this is the first year of business of Subhash, then last year turnover is 0. Therefore, Subhash is not liable to TDS, right? Subhash is not liable to TDS, and therefore on all the transactions, in all the transactions that the seller will collect the TCS on all the, including the first one. Okay, I hope it is clear. If this is the first year of Subhash business, then Subhash will not collect TDS, will not deduct TDS, because the last year turnover 0. Therefore, from on all the transaction, including the first transaction, the TCS will collected by the seller. Seller will have to collect the TCS. I hope it is clear to all of you. Fourth question. Are the provisions of tax deduction collection at source attracted in respect of transactions with car parts? If yes, who has to collect tax? At source and at what rate? Yes, if the product are sold through e-commerce operator, how much product is sold? 12 lakh rupees, inclusive GST. And GST is not separately given. If GST is not separately shown, then on the entire amount TDS has to be deducted. TDS is deducted on exclusive of GST only if it is separately mentioned in the invoice that this much is this and this much is GST. If GST is not separately shown in the invoice, then TDS has to be deducted on the entire amount. So here on the entire amount, the e-commerce operator carparts.com has to deduct TDS at the rate of 1% under 194O. Under which section? 194O, 12 lakh rupees at the rate of 1%, carparts.com will deduct under 194O. Right? Like Amazon deducts, right? And last, if Mr. Subhash has not furnished his PAN to car accessories and company, but has furnished his Aadhaar number, what would be the rate of TCS? It's okay. You can furnish either PAN or Aadhaar, both would be fine. Even if you furnish Aadhaar, it's okay. Then also 0.1% TCS will only be applicable. It will not be more. You can furnish either PAN or Aadhaar, both are acceptable in today's time. So this is what this question is all about. I hope it is clear to all of you. So let's move on to the case scenario number 2 now. Case scenario MCQ number 2. A Limited is an Indian company which has invested in the shares of other Indian and foreign companies. So A Limited has invested in the shares of Indian company also and foreign companies also as follows. As you can see over here in different companies. This is the percentage of holding. This is the date of declaration of dividend. This is the date of distribution of dividend. This is the amount of gross dividend, and this is the interest expenditure on loan borrowed for investment in shares. Okay. Now A Limited declared and distributed dividend of 6 lakhs for financial year 22-23 in December 23 and dividend of 7 lakh for financial year 23-24 in July 2024. Now Mr. Akash and Mr. Arav are two brothers who have invested in the shares of A Limited. Both of them were born in India. Their parents and grandparents were also born in India. Mr. Akash is an Indian citizen who lives in Hyderabad. He is employed with a leading textile manufacturing company with a salary of 1 lakh per month. His brother Arav is settled in country Y since the year 2010. He is a citizen of country Y and a partner with software development firm in country Y. His share of profit in the firm is $1,20,000 which was credited to his bank account. The value of $1 is 25 rupees. He is not subject to income tax in country Y. Since the share of profit from a firm is exempt in the hands of partner in country Y. Mr. Arav visits India 4 months in continuation every year. He earns interest of 14 lakh rupees from fixed deposit with Bank of India. Okay. Now, the dividend income which is earned by Arav and Akash from A Limited, because they both have investments in A Limited, is as follows. Now, we need to answer based on the most appropriate answer based on the above case studies. Okay. So, this is just a synopsis of case study which I have given you. I'll explain you with the help of the questions. Now, what is the amount of dividend includable in the gross total income of A Limited for AY 24-25 under the provisions of the Income Tax Act 1961. Okay. So now how much dividend will be includable in the gross total income of A Limited? So this 2 lakh rupees is earned. On that 2 lakh rupees, 45,000 is interest. But interest is allowed only to the extent of 20%. Therefore 40,000 will be allowed. Therefore 1,60,000 will be this. Okay. Second one is 4 lakhs. Out of 4 lakhs, again only 20% will be allowed. Therefore 80,000 deduction will be allowed against dividend income. Therefore this will be 3,20,000. Okay. Third one, 6 lakhs you have earned. Again 6 lakhs also you are going to get only 20%. So 20% will come to 1,20,000. Okay. So this will be 4,80,000 deduction dividend income which will be taxable in your hand. And the fourth one is 3,20,000. Against 3,20,000 also again only 20%. that is 64,000 rupees deduction you will get. So the total of all four will be coming to how much? Will be coming to 12,16,000. It is very simple. Dividend minus maximum 20%. Dividend minus maximum 20% and 12,16,000 is the answer to this particular question. Okay. Now, what is the deduction allowable under ATM? The answer given by ICAI over here is wrong. I'll tell you why it is wrong. Okay. Now, they are saying that the company has distributed a dividend of how much? The company has distributed dividend of 6 lakh rupees in December 23. If they have distributed 6 lakhs in December 23, will they get the deduction of this in 22-23? The answer is no. Because if they want deduction in 22-23, then they should distribute 1 month prior to the due date of 22-23. Now they are distributing in December 23. So in 22-23, they would have not got the deduction of this 6 lakhs. So they can take the deduction of this 6 lakhs in 23-24. They can take the deduction of another 7 lakh which is distributed before the due date of filing of return 1 month prior to the due date of filing of return of 23-24. So again I am saying 6 lakhs, will they get the deduction in the last year? No. They would have not got the deduction in the last year because it was distributed after the due date. So in the current year they can take this 6 lakhs. This 7 lakhs can they take in the current year? Yes, because it is before 1 month prior to the due date of filing of return of the current year. Okay. So 13 lakh deduction they can take. So ICAI has blindly taken 13 lakh as deduction and that is the correct answer as per ICAI. As per me, it is not correct. You need to compare this 13 lakh with your dividends. Whatever net dividend you have earned, you have to compare that with 13 lakhs. And then whichever is lower, that is allowed as deduction. According to me, the answer to this question should also be 12,16,000 only. But unfortunately, ICAI has given the answer as what? As 13 lakh rupees. Now forget it, whatever they have done, let it be. Okay, forget about it. What is the tax liability of Mr. Aakash for AY 24-25 under the Income Tax Act 1961? If he wishes to make maximum tax saving, ignore TDS. He wants to save maximum tax and ignore the TDS. So we need to see what all income Aakash is earning. So first of all, Aakash is earning a salary of 1 lakh rupees per month. Okay. Apart from that, Aakash is earning some interest, etc. also. Okay. I don't think so Aakash is earning anything apart from that. Okay. Sorry, Aakash is earning some dividend also. So first of all, Aakash is earning a salary of 12 lakh rupees. From that 12 lakh rupees, he will get 50,000 standard deduction. Okay. Irrespective of whether he is following the old regime or new regime, it doesn't matter. Standard deduction is allowed in both the regimes now. So 1150 is his salary. Now Aakash is also earning some dividends. So Aakash is earning 2 dividends. One is this and another is this. But the second dividend is earned in July 24. So that cannot come here. So only the first dividend which is earned in December 24-23 that will come here. 60,000 is the dividend he has earned and 15,000 he has incurred as an interest, but only 20% will be allowed. So only 12,000 will be allowed. So therefore the Aakash net dividend will be how much? It will be 48,000. Okay. So Aakash is earning two things, 11,50,000 as his salary and 48,000 as his dividend income. Therefore the total will come to 11,98,000. Okay. Now, total income will be same under both 115 BAC as well as under the normal provision. Okay. Now, we need to compute tax as per both of them and whichever is more beneficial, that will save his maximum tax. Now, tax as per 115 BAC, that is the new regime, is coming to 93 to 90 if you compute the tax. And as per old regime, it is coming to 178, 780. Therefore, we will go for 93,290, which is the correct answer. Okay. I hope it is clear to all of you. Now, what is the residential status of Mr. Aarav for 24-25? Now, see, Aarav stays outside India. He comes to India only for 4 months. Okay. So, suppose let's assume that he comes to India for 4 months. It means he comes to India for say 120 days. So, if he comes to India for 120 days, then also he need to fulfill for few more conditions. That is, in the last 4 years, he should stay in India for 365 days. Chalo, that is also he is fulfilling, because if every year he is coming for 4 months, then he is fulfilling the criteria of 365 days in the last 4 years. Because if every year is coming for 120 days, that is 4 months, then 4 years it will come to 480 days. One more criteria he has to fulfill. He has to fulfill what? The criteria of earning more than 15 lakh rupees from Indian source. Now that he is not fulfilling. He is only earning 14 lakh rupees from the fixed deposit in India. Apart from that, I don't think so he is earning any other income in India. Therefore, he is not fulfilling that criteria, and that by that logic, he is a non-resident in India. Okay. Now let us compute the taxable income, that tax liability of Mr. Aarav. Aarav is earning 14 lakh rupees income from FD and he's also earning, dividend from India. How much? Dividend of 90,000 rupees from India. And in July, whatever he is receiving, that will not come over here. Okay, whatever dividend he has earned in July, that will not come over here. Whatever dividend he has earned in December, that will definitely come over here. So in December he is earning 90,000 rupees, and because he is non-resident, he is not going to get the deduction of 20,000 rupees. That deduction of interest is only allowed to residents, that is not allowed to non-resident. So his total income will come to how much? His total income will come to 14 lakh plus 90,000 rupees. Okay, and therefore institute, I guess, has taken over here that 18,000 deduction also. Okay, according to me that is incorrect. They should not take that 18,000. They have taken 20% deduction here also, and that's by that logic they have taken this income as 14 lakh 72. So according to me that is wrong. They should not do that. Okay, why they should not do that? Because for non-resident, the dividend income is directly taxable at 20% under 115A. So they cannot take the deduction over here. I think so that is wrong. Okay, that should not be done over here. But let's see, as per ICAI, whatever is the answer is coming here. As per ICAI, 14,72,000 is the income, and therefore on that the assessee will get what? As per normal provision, it is 2,60,000, and as per 115 BAC, it is 153,920, and therefore 153,920 is more beneficial to the assessee. I hope it is clear to all of you. This is what your case scenario 2 is all about. Okay. So let's move on to the next case scenario, that is case scenario MCQ number 3. BMT Shipping Company is an Indian company. It is an Indian company having its place of effective management in India. The poem is where? The poem is in India. It's an Indian company and the poem is in India. Now it owns 3 vessels, out of which 2 are qualifying ship. Now this entire question is on tonnage taxation concept. Okay. So let us see what is this exactly the question is all about. The registered tonnage of 2 qualifying shipping company is 33,840 tons, 230 kg, and the second one is 24,952 tons and 370 kgs respectively. This is the registered weight of the tonnage of the companies. Okay, of the 2 companies which are qualifying to be a tonnage company. In financial year 23-24, the first vessel operated for 212 days. And the second vessel operated for 347 days. Okay. Now the WDV of the block of asset for tax purpose being shipped as on 1/4/2022 was 1200 lakhs. So tax purpose, the WDV of the asset is 1200 lakhs, and the WDV as per books is as follows. Qualifying ship is this, qualifying ship 2 is this, non-qualifying ship is 230 lakhs. And this, the WDV as per books of accounts is given in the box, and WDV as per tax is given above the box, that is 1200 lakhs. Okay. Now the profit from core activity referred to in section 115 VI is 70 lakhs. The profit from core activity means the activity of tonnage. It is 70 lakhs. Profit from incidental activity, it is 14 lakhs. Therefore, this is the total profit. 84 lakhs is the total profit which is earned by the company. Okay. Now the book profit as per 115 JB, it is 100 lakhs. Okay. Now Element Shipping Company is a foreign company whose place of effective management is outside India. Now this will be useful in the last question, so we will read that at the end. Okay, now it is not relevant. Now what would be the tonnage income of BMT Shipping Company computed under 115 VG? Now see, for that you need to know the slab rates of the tonnage taxation company. So what is the tonnage taxation? What is the tonnage income of this particular company? First of all, the first company, what is the weight of the first company? First company's qualifying ship weight is 33,000 ton, 33,840, 230 kg. Now, how the income will be computed? Up to 25,000, it is 11,770 rupees per day. Go and check the chart. Up to 25,000, up to 25,000 ton, it is 11,770 flat. Above that, for every 100 ton, it is 88 rupees. It is how much? For every 100 ton, it is 88 rupees. Okay. So this is how you will compute and multiply by 212 days. I hope it is clear to all of you. After that, for every 100 ton, it is how much? For every 100 ton, it is how much? It is 88 rupees. Plus what? Plus what? Multiply by 212. This will come to 30,36,264. What about the second ship? The weight of the second ship is 24,952. So up to 10,000, it is 5470. Okay. And above 10,000, for every 100 ton, For every 100 ton, it is 42 rupees. And here it was for every 100 ton, it was 29 rupees. I said the opposite way. I said the other way around. Sorry for that. So about 10,000, up to 10,000 ton, it is 5470. About 10,000 ton, for every 100 ton, it is 42 rupees. So multiply by number of days the ship was operating, 347. So therefore, the answer will come to 71, 24, 54. It's a mere calculation wala sum. There is nothing great in this particular question at least. Okay. Now, what would be the written down value as on 1/4/2023 for the qualifying ship of BMT Shipping Company for tax purpose? See, for tax purpose, we need to find out the written down value of the qualifying ship. Now, we have written down value as per income tax law for all the three ships. Now, for all the three ships, it is how much? As per tax, it is 1200. Okay. And for all the three ships, as per accounts, it is how much? As per accounts, if I total all three of them, it comes to, as per accounts, it is 1080. So for all the three ships, as per tax, it is 1200, and for all the three ships, as per accounts, it is 1080. So how much is the value of tax as per value of qualifying ship as per tax? So for that, we need to know the value of qualifying ships as per these two accounts value. So what is the value of 580 plus 270? Whatever is the value of 580 plus 270, it is 850. You can cross multiply and you can get the answer of what? Answer of tax value for the two ships. Okay, it's very simple here. You have the value of three ships as per tax. You have the value of three ships as per books of account. You have the value of two ships as per books of accounts. You can do the calculation and you can get the value of two ships as per tax also. Okay, cross multiply and get the answer, as simple as that. Now the next question, the minimum reserve requirement as per 115 VT in case of BMT shipping companies for previous year 23-24 is how much? Now how much money has to be transferred to reserves by a tonnage taxation company? Remember, the law says that at least 20% of the book profit has to be transferred to the tonnage taxation reserve every year. Otherwise, you are not going to get the deduction. Okay, you are not going to get the benefit of tonnage taxation. Now, the book profit of this company is 100 lakhs. So 20% of that will come to how much? 20% of that will come to only 20 lakh rupees. So 20 lakh rupees has to be transferred to tonnage taxation reserve. Otherwise, you will not get the benefit of tonnage taxation reserve. I hope it is clear to all of you. The fourth question, would any amount be taxable under other provisions of the Income Tax Act as per 115 VT if BMT shipping company had transferred 15 lakh to tonnage taxation reserve? So they have transferred how much? 15 lakh to tonnage taxation reserve. So how much is the shortfall? The shortfall is 5 lakh rupees. And how much they were supposed to do? They were supposed to do 20 lakh rupees. So how much they are doing shortfall? They are doing shortfall of 25%. So whatever shortfall they are doing, the total profit, whatever is the total profit, out of which whatever shortfall they are doing, that much will be taxable in their hand. Okay, that much will be taxable. For example, if 20 lakh is required to be transferred and if entire 20 lakh is transferred, then nothing will be taxable. If 20 lakh is required to be transferred and only 15 lakh is transferred, it means 25% mistake you are doing. Therefore, on 84 lakhs, 25% will come to how much? 21 lakhs, and 21 lakhs will be taxable in your hand. I hope it is clear to all of you. And last but not least, for that we need to read this particular data which is given over here. Element Shipping Company is a foreign company whose place of effective management is outside India and its gross receipt is 630 lakhs. The breakup is as follows. The goods shipped at port in India, will that be taxable in India? Yes. Both of them will be taxable in India under 44B. 44B, 7.5% will be deemed income. Okay. What about the goods which are shipped outside India? The goods which are shipped outside India will be taxable only if it is received in India. Therefore, 180 lakhs will be taxable and 100 lakhs will not be taxable. So, you have to take a total of all of them and then 7.5% of that will be your deemed income. Okay. So, take the total of all of them, all three of them, and then take 7.5%. That will come to 39.75 lakhs and that will be your deemed income under the income tax law. So, this is what this question is all about. Okay. Now, one last question over here that will complete all the MCQs which are there on the ICAI website and which I have made you as a commitment to my dearest South Indian students who struggle to understand English, and because of that I need to again and again record everything in full English. But no matter, I will do it for you all. Don't worry about it. I will do it happily. Okay. Case scenario 4. Mr. Rajat is a diamond merchant. During the previous year 23-24, he has a turnover of 20 crore and net profit of 60 lakhs after taking into account all permissible deduction. He has invested in the shares of various private limited companies from which dividend of 12 lakhs is receivable by him. He has two house properties in India. Both of were self-occupied. One of the property he had taken on a loan of 50 lakhs on which interest is payable was rupees 2,50,000, out of which he paid 1,80,000 during the year. On his birthday, he received jewelry from his friend. Fair market value of the jewelry is 5 lakh rupees. He has also withdrawn cash of 1.2 crore rupees from the bank account, current account with ABC Bank. Further, he has also withdrawn 50 lakh rupees from a cooperative bank account in October 2023. He is regularly filing the return of income. His brother, Mr. Rahul, has not filed the return of income for the last 5 years. Even though his total income exceeds the basic exemption limit, he withdrew 50 lakh from the cooperative bank account. Mr. Rajat has a voting power of 20% in XYZ Private Limited, a closely held company engaged in diamond manufacturing from which he has obtained a loan of 10 lakh rupees. The company has a free reserves of 8 lakh rupees. Now let's see one by one all the question. Question number 1. Which of the following statement is correct in respect of 10 lakh loan obtained by Mr. Rajat from XYZ Private Limited? So, how much loan Rajat has taken now from XYZ? See, Rajat has 20% stake in XYZ Private Limited, which is a closely held company. Now remember, if any shareholder has 10% or more equity power, voting power in any other closely held company, and if that company gives a loan to the shareholder, then it is deemed dividend. So if I am a shareholder, I have 10% equity in your company, which is a closely held company, and if that company gives me what? A loan, then that is deemed dividend. Deemed dividend will be how much? Deemed dividend will be subject to what? Deemed dividend will not exceed your accumulated reserves. So the company has given me a deemed dividend of 10 lakh, but my accumulated reserves is only 8 lakhs. Therefore, only 8 lakh will be taxable as deemed dividend under 222E in the hands of Mr. Rajat. I hope it is clear to all of you. Is it clear? I hope it is clear. Okay. Now, second one. Would cash withdrawal by Rajat during the previous year 23-24 attract deduction of tax at source? Let's see how much Rajat has withdrawn. Now, Rajat has been regularly filing the return. Okay. Rajat has withdrawn 1.2 crore from ABC Bank and he has been regularly filing the return. Okay. He is regularly filing the return. So, if he is regularly filing the return in excess of 1 crore on 20 lakh rupees, 2% TDS will be deducted by the bank. Okay. So, in this case, 2% TDS will be deducted by the bank. In second case, he has also withdrawn 50 lakh rupees from cooperative bank. So, cooperative bank will not deduct TDS because it is not exceeding 1 crore rupees. Okay. So, therefore, in the first case, he will deduct. Yes, tax is required to be deducted at 2% on 20 lakhs under 194N by ABC Bank. Cooperative bank will not deduct TDS because the threshold is not exceeding 1 crore rupees. Okay. I hope it is clear to all of you. Would cash withdrawal by Mr. Rahul during the previous year 23-24 attract deduction of tax at source? See, Rahul is not filing the return for the last 5 years. Now remember what the law says. If you have not filed the return for the last 3 years continuously, then the bank will deduct TDS in excess of 20 lakh rupees. So how much Rahul has withdrawn? Rahul has withdrawn 50 lakh rupees. So now the bank will deduct TDS in excess of 20 lakh rupees. That is, the bank will deduct TDS on what? On 30 lakh rupees, 2%. Okay. I hope it is clear to all of you. Because Rahul is a non-filer of ITR. So in case of Rahul, 2% TDS will be deducted on 30 lakh rupees. Okay. I hope it is clear to all of you. Okay. That is 2% in excess of 20 lakh rupees. Now next one. What is the total income of Mr. Rajat? Assuming that he has shifted out of the default regime and pays tax under the normal regime. Now see. So he does not want to go under the default regime. He wants to go under the normal regime. Now let's see what all incomes he is earning. First of all, he is earning a profit of 60 lakh rupees. Correct? So that I am writing over here. Pay attention please all of you. Pay attention. So he is earning a profit of 60 lakh rupees. I am going in the order of the question. Then he is earning some dividend of 12 lakh rupees. Correct? So I am writing this over here. He is earning some dividend of 12 lakh rupees. Correct? I am going in the order of the question. Then he has two house property on which he is paying an interest of 2,20,000 rupees. Okay. Both of them are self-occupied. Okay, out of which 1,80,000 is paid. It doesn't matter. House property interest is allowed on accrual basis. House property interest is allowed on accrual basis. Therefore, he will get the interest of house property 2 lakh rupees loss deduction. In the old regime, it is allowed. In the new regime, it is not allowed. Okay. Then what is the next income he is earning? He has received some gift from his friend, 5 lakh rupees jewelry. That is also taxable under IFRS. And he is receiving deemed dividend of 8 lakh rupees. Okay. So on 83 lakh rupees, we need to compute his tax. Okay. I hope it is clear to all of you. What is the total income of Mr. Rajat, assuming that he is shifted out of what? out of the default tax regime. Okay. So therefore his total income comes to 83 lakh rupees. Actually the answer is not 3, answer is not 4, answer is 3. Okay, answer is 3. So answer is 83 lakh rupees. Now we need to compute tax. Okay, in the next question. So again I am saying the previous question, no confusion. 2 lakh rupees house property loss. Accrual basis also allowed, interest is allowed on accrual basis also. PGBP 60 lakh directly given. Gift received from friend jewelry 5 lakhs. Dividend, normal dividend, a deemed dividend and normal dividend, total 83 lakhs. 83 lakhs is the correct answer. It is not 83.4. Okay. Now one last thing. What is the amount of gross tax liability of Mr. Rajat, assuming that he shifted out of the default regime? He is paying tax as per normal regime. So if he is paying tax as per normal regime, so on 10 lakh he will pay 1,12,500, and on remaining 73 lakhs he will pay 30% tax. Okay. Then 10% surcharge also, because he is earning income of more than 50 lakhs, 10% surcharge will be imposed, and 4% cess will also be imposed. Okay. So therefore the tax of Mr. Rajat will come to how much? 26,34,060 rupees. I hope it is clear to all of you. So this is what the MCQ session is all about, and this is what my commitment is all about towards all my dearest students of South India. I have made a commitment to you all that I will be making a video on all the MCQs of ICAI, which the ICAI has uploaded on their portal, and I have done it. Okay. I will also put the timestamp below. It may happen that when the video is uploaded, initially the timestamp is not there. It might be uploaded. It might be updated in next 1 or 2 days. Okay. So don't be in a hurry to get the timestamp. But I will be uploading the timestamp chapter wise and MCQ wise and nature wise also. Chapter 1, simple MCQ 1, simple MCQ 2, simple MCQ 2. Chapter 2, simple MCQ 1, simple MCQ 2, medium MCQ 1, medium MCQ 2, difficult MCQ 1, difficult MCQ 2. In that way, we will be putting we'll be putting the description also in the form of what? In the form of your entire timestamp. So don't worry about it. So it might not be updated immediately. The video is uploaded. It will be updated in next 1 or 2 days. Okay. So take care all of you. Your rest of the revision videos I'll try to upload soon in full English, that is transfer pricing, non-resident, TDS and chapter of trust. Okay. Take care all of you. Bye all of you. Take care.